as it's being called now. But before we start, I would like you to, I would first of all say congratulations for enrolling with CFA, for enrolling for CFA exam. This is the most prestigious qualification in the finance industry. And that's the truth. And that's why the exam is kind of challenging, let me put it that way. So I encourage you all, don't stop on level 1. Try as much as possible to finish it and get to the final level. I wish you guys luck, Godspeed, everything that you need to succeed, right? All right, so the FSA this morning, we will quickly, I want to test you guys' knowledge on some things. So we will quickly have some quick quiz. It's going to be like 15 questions. After that, then I will run you through the topics that you have. It's not going to be like in-depth as you are reading, but it's just going to be like a summary and some key things that you need, hopefully. So if you're able to finish all those ones before the time, you can take another quiz, right? Hopefully. All right, so that's that. Now, let me share my screen and let me know whenever you can see my screen. Then we can start with the quiz. I'm sharing my screen now. Can you see my screen? You just see
Not yet.
Not yet. We can't see your screen.
Oh, voila. Let me see this one. Yeah. Can you guys see it now?
Yes, it's up now.
It's up. Good. All right, so let me just put it in the presentation mode so that it's easier. So guys, unlike before, let me just run you through this, your topic weight. There might be slight changes, but you know, the weight is not static, it's a range, right? So, however, there's some key topics that you need to be aware of, right? FRA is like 15%, ethics, equity, fixed income, corporate finance. If you look at this 5, you see that it gives you like about 62% of what you need. Then when you add economics and quants to it, that is 20. So you see that this top 7 gives you about 82. So how does this top 7 plays into your functional areas? If you see, so now you have 4 functional areas. The first one is ethics and profession. It stands on its own, ethical and professional standard. It's a functional area on its own. Then the next one is tools, right? Your tools, we have your quantitative method, economics, and FSA that we're talking about now. So if you look at your tools, you see that economics, FRA, they are there, plus quant. So part of your top 7, 3 of them are in your tools. Yeah, so you need to be careful about that. And that is the way your exam will definitely flow. So under your portfolio management, you have your corporate finance and you have your portfolio management. I don't expect anybody to miss anything in these two, that corporate finance and portfolio management. They're a good way for you to quickly catch up on some things, right? That you might have missed in quants or because of the topics or because of the bogus or unending formulas, right? The last one is asset, where you have your equity, fixed income, derivatives, and alternative investment. You see that under assets, you have 2 big weights there, which is your equity and fixed income. Derivatives is not that big in everyone. I don't expect it to give you so much problem, as well as alternative investment. So if you look at all these functional areas, you will definitely see that there's some things you can use to patch up on some of those big 7 that you might have missed somewhere, right? So try as much as possible not to, there's no negative marking, right? If you don't know number 1, move to number 2. If you don't know number 2, move to number 3. It's multiple choice, right? So as much as you can, try to see, because some of these things, the other ones might be the ones, or the ones that you're not comfortable with might be at the upper stuff, but the lower ones might be the ones that you can easily score good marks, right? So don't be stuck in trying to get that thing. And don't fall in the trap of overconfidence. Because you are so comfortable with FSA, you know this topic in inventory, LIFO, I can calculate LIFO, I can calculate FIFO. Then you now see it, a question there, you are not trying to get it right. It's only 1 mark. You can easily go to corporate finance and score all the 5 or 7 there. So be very strategic, let me put it that way. And for some of us there, don't fast. If you are very good in fasting, you are religious, that day is not the day for you to fast, right? Fast before or fast after. You need enough adrenaline, right? So try as much as possible to eat well, drink enough water, well, oil your body very well. You have to be mentally alert, yeah? So that's just the brief thing. Then we are going to our quick quiz now. I want you guys to be dropping your answers there. By the time we are done with the first 10 or the 15, I'll give you all the answers. And the person that scored highest, definitely we will see what we can do. So that's your topic, right? We have about 5, 4, about 11 there. These are the things that there. You have introduction to financial statement analysis. You have your financial reporting, understanding income statement, balance sheet, cash flow, financial analysis technique, inventory, long-lived assets, income taxes, financial reporting quality, non-current liability. So there are some there that easily, but I expect in level 1 that the examiner will definitely ask you on some of these things that conflict between, or the differences, don't let me say conflict now, the differences between IFRS and US GAAP, especially in the treatment of inventory, long-lived assets, in the treatment of impairment, reversal of impairment. So these are the things we will look at, right? All right, so now let's go with the quiz now. That's it there. When you are done with the number 5, the 5 on, I'll move to this second slide. I want you guys to be, I want to be seeing your answers. Just be dropping your answers there. So just do your name, put the 1 to 5 there so that it's easier for us to track. Can you all hear me loud and clear? Because I'm seeing a message from someone now saying that I should adjust my volume. Ah, okay. I can see people have already answered. All right, that's good then. Okay. Rose is saying I should speak louder. Okay. So don't give me 1, this, that. Just do first to 5, right? Like the way Biola is doing now, or Abiola, CBCAB. Give me your 1 to 5. Give me your, let's flow that way. Austin too is saying CBBAB. Yeah, I want to see it in that format, right? Okay, 2 minutes left on this slide. Then I move to the next 5. All right, I'm moving to the next 5 now. Try to keep all your answers. We will see the person that scored the highest, right? All right, on to the next 5. This is actually 4. So this will take you another 10 minutes maximum. I intend to have just a minute and a half per question. But I can still make allowance for 2. Let's see. Just be putting the numbers there. 1 to 5, 6 to 9. Yeah, so that we are not, so we don't confuse it, right? Okay, I'm moving to the last set of questions now. The last one, 10 to 14. That should take you another 10 minutes maximum. 2 more minutes, please. All right, guys, time's up. Let's see. Can you score yourself, guys? And let's see. Michael, we are done, right? Let me see who scored the highest, and if you can type the questions I give you the that is most challenging to you, right? Okay. Inventory. Someone is talking about inventory. These scores are not. I can say, okay, I can see 13. I can say 10, 11, 12, most challenging. Okay. I can see 9. I can see 13. Just be honest with all these things. That's the best one. 10. Some are encouraging, some are not so encouraging. Let's go through the questions. Okay. Okay. 11 to 14, 9. Okay. Inventory is challenging for me. Okay. Okay. This is one of the best way to test yourself. It is very review of what the differences between that. So it is very easy for me to come here the slides, we talk through the topics, but you might not be able to apply it. We've been doing this for a long time now, so we know that it can be easier in class, it can be easier when you are listening to it, but it can be challenging when you are trying to actually apply it. And that is why so many students fail to pass the exams, right? Okay, let me quickly run through the questions, then we can quickly look at it. I can see the major thing that you guys are lacking here is the difference between GAPs and IRSs. So that means that you guys, you can be able to identify your weaknesses from this little quiz. So that means that you need to go back there and check it out. Try to check what and what you need to understand more. I will talk about some of them during the course of this class, right? Okay, let's quickly look at this. Let's look at number one. Which of the following best describe the role of financial statement analysis? I don't expect anyone to miss this. If Naya said she scored 40-40, I think I saw 40-40 with another person again. So which one? It said to form an A, to provide information about the company's performance, to provide information about the company's changes in financial position, to form expectation about a company's future performance and financial position. What are you analyzing? So why are you doing analysis? That is the purpose of you doing analysis. C is the best choice here. That's the purpose of you doing the analysis, right? So I think you should be able to know all this probably. And the number two said the role of financial statement analysis is best described as what? The role. Why are we doing that? What is the role of the financial statement analysis? So I think these are part of your first topic, right? These are part of your first topic, which I think you should be able to grab easily without any question in there. Do anybody have any issue with number 1 to 5? So I can skip so that we can quickly move to the challenging one. Anyone with anything you want me to talk about here? Number 4, information about management and directors' corporation are least likely to be found in. So another thing you should be careful about is most likely, least likely. Information about managers, management and directors' compensation are least. They did not say most likely to be found. So you have to be careful with this most likely, least likely. You can never find management and directors' compensation in an audit report. You can't. Definitely, you can see it in the notes to financial statement. Yes, they can put it there. You can also see it in the proxy statement. Yes, but you can't. I've never seen. I don't know, because the auditor's report is to express an opinion on the fairness, and truthfulness of the financial statement. Rose, they are not asking you about director's fee. They're asking you about their compensation, the salaries, the bonuses they get during the year, loans, everything. So you can't. It's not in the distance. So the point is this: be careful about that list and most likely. All right. So number 5. Somebody mentioned number 5. It said information about the company's objective, strategy, significant risk are most likely to be found with information. So I think it's still the same thing that underlying most likely, least likely. So ask yourself about the company's objective, strategy, significant. Are you likely going to see it in audit reports? Their strategy? Are you likely going to see it in notes to financial statement? Are you likely going to see it in the management commentary? The management commentary is an avenue for the management to actually explain and tell you everything about their companies. Oh, this is what we are doing. We are trying to enter the South American market. We are trying to enter Nigerian market. So be careful about that least likely and most likely. Is that fine? Yes. Yeah. Yeah, it's the right. So another person is asking for number 2. Wow. So I've ended up doing the whole stuff, right? The role of financial statement analysis is best described as providing information useful for making investment decisions, evaluating a company for the purpose of making economic decisions, using financial reports prepared by analysts to make economic decisions. Yeah, I get your point. It can be tricky, but it's saying the role. not the use from the investor's side. So you need to be able to separate that, right? When I'm doing financial analysis, I just want to evaluate that company for the purpose of making economic decision. I'm not saying I want to use the financial reports prepared by analysts to make economic decision. The role of you doing that, right? So I think that should be that. Number 6, what type of audit opinion is preferred when analyzing financial statements? I think you should know that anything that has to be with, anything that is qualified, adverse, qualified is saying except for this and these, there is, adverse opinion is saying this is not true and fair. So unqualified opinion is the clean opinion there, right? Any other thing here? I think you need to read up on all this conceptual framework as well, right? They are very key. Like this one saying that according to the conceptual framework of financial reporting, which of the following is not an enhancing qualitative characteristics of information. What is this one? Let me hide this. Information in the financial statement is not. What is not? Is accuracy there? Timeliness, compatibility? Yeah. So you see that they are not asking you that what it is. Qualitative characteristics, I think they are majorly 2, reliability and faithful representation. Those are the major 2, right? And all those under 2, you have understandability, comparability, timeliness, and all these things. So enhancing this thing is not, accuracy is not supposed to be there, right? All right, so that's that. The assumption, which of the following is not a constraint, is not a constraint, is not a constraint. Benefit versus cost is actually a constraint. Balancing the qualitative characteristics, understandability is a conceptual framework. That one is not a constraint, right? The assumption that the effect of transaction and other events are recognized when the occur, not where cash is flowed, this one should be a go for everyone. Is B, accurate basis. Accurate basis is saying that record transaction when the event occur, not actually when cash is paid or received. This is the best concept that has happened in the last 100 years, in my opinion, right? So expect such. Any other thing, guys? If inventory unit costs, if inventory unit costs are increasing from period to period, a LIFO liquidation is most likely to result in an increase in worth. Now see, let's look at this. What is LIFO? LIFO is saying that last in, first out. So that means that it is the most recent purchases are the ones that you are likely going to sell now. So when prices are increasing, as they are going up, you are selling the most recent one. What does that mean? It means that your cost of goods sold will be higher. It will be higher, right? If your cost of goods sold is higher, if you take your revenue minus your cost of goods sold, as compared with FIFO, you will agree with me that your gross profit margin will drop. If your gross profit margin drops, what does that mean? What will likely increase? Will your inventory, so this is how you can do it in the exam as well. So that means A is off. An increase in, there will not be an increase in gross profit. It will actually be a drop. Yeah. Another thing you should check out is if I'm selling the last one now, so I bought this one for 2 million now. The previous one that I bought was 1.5. This one is 2 million. The 2 million is what I'm selling now at 2.5. If I've sold the one of 1.5, I will have made a gross profit of 1 million. But because I'm selling, as in I'm reporting the one of 2 million, and that means that my gross profit will be what? 500. That means there'll be a drop in gross profit. Now, if there's so what am I now going to carry as my inventory? My inventory will be the previous one, which is the 1.5. So will there be an increase in my inventory carrying amount? No. So that means that we have actually eliminated A and B That's it, A and C. So that means what will increase will be your what? Inventory, your LIFO reserves. So that's how you, so remember, during the increase in prices, LIFO will definitely, what are you saying? I don't understand. What are you guys saying there? Oh, you are saying that the answer is A. Oh, maybe I can recheck this answer. It might be that there's this thing there. So if the unit cost is increasing from period to period, so I'm selling, LIFO liquidation. That's what they are saying here. Yes, the answer is A. So, sorry, they're not talking about cost of goods. So they're saying about LIFO liquidation. Yes, exactly. So this explanation also explains what I've said. Explain it, right? So if I sell the 2 million and I'm selling for 2.5, 500K is my gross profit. That means that my gross profit will drop. My inventory carrying amount will definitely be lower. But in the event of LIFO liquidation, remember, LIFO liquidation means that you are liquidating the previous ones. You are liquidating the previous 1.5, 1 million. If you are now selling those ones now, then definitely your gross profit will definitely what? Increase. They are not asking. See now, I also thought they were asking for gross profit. They are asking for some. I didn't read the questions properly. So these are the things that you need to be careful about. So what they're asking for is LIFO liquidation. Yes, when inventory are increasing, definitely your gross profit will definitely increase during LIFO liquidation. The liquidation means you're selling the previous one. Yes. Carrying value, carrying inventory at a value above its historical cost will most likely be permitted if, one, the inventory was held by a producer of agricultural product, the financial statements were prepared using US GAAP, the changes resulted from reversal of previous write-down. The most obvious answer here is the agricultural produce. Yeah, is the most obvious answer here is agricultural, because that is the only that you can have a carrying value at a value above its historical cost that is permitted by the standards there. Yes. So that's that. Number 12, I want to quickly run through all this. Number 12, I don't know why my also, let me just move these your answers. I'm trying to check your chat at the same time that I'm doing it, so it's confusing. Let me move it down. All right, Eric's use bookstore prepared information in accordance with this. Inventory was purchased 1 million and later marked down at 500. One of the books, however, was later discovered to be a rare collectible items, and the inventory is now valued at 3 million. The inventory is most likely reported on the balance sheet as at what? It's very obvious. So now let me ask you this. Can you reverse a previously impaired product under US GAAP? Yes or no? Yes or no? No. Fantastic. Under IFRS, can you do that? Yes. But under IFRS, if you can do that, subject to what? To the marks of the historical cost. Exactly. So that means that whatever the case is, so the examiner is just trying to test you on this. Oh, do you know that it can be reversed under IFRS? Yes. If it can be reversed, it is subject to the maximum of the previous write-down. So the obvious answer here is A, right? A is B. Now, guys, let me tell you what FSA is all about. FSA is all about reporting what has happened in the past. That's all. There's an historical event. We made some sales. We made some expenses. We have some assets. Yes. Now, how do you report them based on a particular guideline? Are you reporting them based on IFRS? Are you reporting them based on US GAAP? That is everything about FSA. Reporting your past events based on a guideline. So those guidelines your US GAAP and IFRSs. So what does this IFRS say about revenue? Then it is what I will use to report it. What does this say about cost, inventory, fixed asset? Is the asset a physical one or intangible? What does the guideline say? And that's it. That's the best way to approach it. And don't see it as something that is bogus, right? Now, the 13, it said Fernando's pasta purchases inventory and later write it down. The current net realizable value is higher than the value when the write down. Fernando inventory balance is most likely to be just what we have just talked about. So if the net realizable value now is not higher than what was being done, so under US GAAP, will the guy be able to reverse that? No. IFRS, will the guy be able to reverse it? Yes, subject to the maximum. And they said that Fernando inventory balance will most likely be what? Higher if it complies with IFRS, higher if it complies with both. It's not the same. C is out of it. It can be higher when it complies with US GAAP because there is no what? Reversal. So the obvious answer is your hit, right? Number 14, the last one, it says a write down. Yes. Yes. When there's an impairment, there's no reversal. All right. So a write down of the inventory, a write down of the value of inventory to its net realizable value will have a positive effect on worth. So if you write down an inventory, will it have a positive effect on your balance sheet? Definitely not your income statement, because if you write down, it's a loss to your income statement. It will definitely reduce your what? Profit. These are the ways you need to analyze and do your elimination. If you write down an inventory, it will definitely reduce your asset base in your balance sheet. Is that a positive impact? So the obvious one is that it can increase your inventory turnover because your numerator depends on how it will have what? Reduced. And that's that. Any question now? Anything, just type as I'm moving to the, any question? Any question? All right, in the absence of none. So as I'm going on, just type. I'm trying to check your chart as well. So let's quickly run through your topics. Introduction to financial statement. I think we've talked about that in part of your quiz. So you need to be able to understand the process of your financial statement. What are their roles? If you check, it is part of what you have seen there. The role of financial reporting and analysis is to provide information about the company's performance, financial position, changes in financial position, etc. It can also be used to evaluate equity investment, evaluate your mergers and acquisition. It can be used for myriad of things, right? But the purpose of it is that you want to see whether that company is viable or not. Remember, when you are doing this, it will help you to make what we call an informed economic decision. You don't want to invest in a company that down the line, maybe in a year or two, then everything goes south, right? So that's the rule there. Now, there is this accounting equation, right, which is saying asset equals to liability plus owner's equity. What we are saying is that for every asset that you have, it must have been financed either through debt, that is liability, or through owner's equity. This singular equation is also what you can see as the capital structure of the company, right? So, you know, companies are usually financed through equity or debt. That is the financing. What are they being financed for? They are being financed to finance their operations. So they can either borrow as in form of liability or take funds from their owners. So that is your this thing there. And your income statement is basically your revenue minus your expenses. It will give you your income, add other income to it. So just that's that there. And you also have balance sheet. Your balance sheet is your statement of financial position, right? And your cash flow is divided into three. You have operating cash flow, which involves all your normal transactions. Your operating cash flow is basically your income plus your changes in equity, and plus your changes in working capital. That is, so look at it this way. You need to be able to understand what is called use of cash or source of cash. If I should sell to someone and my receivables is increasing, what it means is that I'm selling my receivables, because for me to have sold, definitely I must have expended some funds to be able to provide such service or products. So, and if I've not collected my money back, it means that I have already used this word cash. So the increase in your receivables is a what? Is a use of cash. But if there is a reduction in your receivables, it means it's a what? Is a source of cash. That means that those guys have paid you. Likewise, inventory. If your inventory is increasing over the period, what does that mean? What does that mean? It means that I've spent some money to be able to put those inventories in my books. So that means it's a what? Is a use of cash. But if my inventory should reduce, it means that I've sold. So that means I've collected some more cash. That is source of cash. So this is an inverse relationship with payables. Some people have already provided some services to me. I am here to pay them. So it's a good source of cash. We call it free funds. Why? Because they provided their services to me, I'm using, instead of me to pay them, I'm using their money to fund other operations. But if I'm paying them, it means that I've used this word cash. I've paid out cash. So there'll be some tricky questions here, obviously, but with this explanation, just put it at the back of your mind. The I'm paying cash. Somebody is saying my voice is low. Guys, I can't be shouting here that I am, right? I'm somehow in transit, so I'm trying as much as possible not to even inconvenience other people, but I can increase. How about now? How about this tempo? Hello, is this tempo? Okay, oh, all right. So just note that, put that there at the back of your mind. Increase in receivables. I've definitely spent some money, and these guys have not paid me back. This is just the major trick that you need to understand there. All right, and we also have your financial statement notes. You should be able to know that those notes can also help you in doing some evaluation or analysis of the financial statement of the company. Why? Because those notes will have some qualitative explanations about the figures that you're trying to analyze. And we also have the management discussion and analysis, right? Where you can see the impact of the balance sheet financing or obligations. You can see the accounting policies that require some judgment, some forward thinking about the objective expenses. So look at that number one. It said IFRS guidelines recommends that management commentary addresses the nature of the business. This is one of the questions that we just did, right? And that's why I'm reading it out. It said address the nature of the business, management objectives, the company's past performance, the performance measures used, and the company's key relationship, resources, and risk. These are the things that you can see there. All right. Okay. All right. So the next one is on the audit reports. So you can have, just like I've said, the audit report is just a complementary to, another eye has actually looked at the financial statement of that company, seeing that, remember, the audit report is not like a police, but we can even see it as maybe a financial police, because police is supposed to be the regulators, right? But the auditors, what they want to do is they want to look at your books, they want to look at your transactions, having in mind that what you are presenting is that you are saying that, oh, whatever that has happened in the past 12 months or 18 months, as the case may be, this is how we have recorded all those past transactions. That's it. Oh, this is where I've recorded. So their own now is now to check. So theirs is now to check what you have recorded in line with what the standard says, to be sure whether you have recorded it properly or not. So what usually causes the fight between the auditors and the complaint? Oh, IFRS 2 says this, you have done this. Can you comply with this? So based on their own, they might now say, oh, guys, you did not comply. So they can say, you did not comply in its entirety. That means it's an adverse opinion. And they might say, oh, okay, except for your impairment, every other thing is okay. But they can say unqualified opinion is a clean report. We did not see anything there. So in audit, we normally have this form matrix, right, to see where the boxes can be. So you can check that too. And other sources of information that you can get is the SEC filing, 10K, So anytime you see K, just know it's annual. Q is quarterly. So don't bug yourself in cramming all those numbers. All right, so now financial analysis framework, there are 6 steps. The first thing you need to do, you need to articulate the purpose and the context of the analysis. What do I want to do? How do I get my information? I need to communicate with my clients. I need to check with my supervisor. Then what are the outputs at this stage? You look at the nature, content of the reports to be provided. So this is the first stage where you now look at, oh, I need to formulate the statement of purpose. What is my objective? What is the timeline? What is the budget? Yeah. Then the second stage is for you to collect the input data. What are the input data that you are looking for? Their financial statement. You can prepare a questionnaire. You can discuss with management. You can also visit the complaint site. What are the output at this stage? Then you must have had what we call an organized financial statement, a financial data timetable or tables. You must have a completed questionnaire if applicable. Then the next stage is process the data. At this stage, you want to get the data from the stage 2. Then you can adjust the financial statement. That is the output. Do what we call a common size statement, ratios, graphs, etc. Guys, I can assure you, the examiner will definitely ask you for some key ratios in the exams. So you need to be able to understand these efficiency ratios, your profitability ratios, that is your gross profit margin, your inventory days, your inventory turnover, receivables days, interest cover ratios. All these things you are going to be asked. So try to understand. If you cannot understand, cram the formulas. Just go cram the formulas. But I think those formulas are easy. But I also expect maybe 1 or 2 questions on return on equity, where you use your DuPont analysis. So, I think in level 1, you have your 2 stages, right? Which is stage 1 is looking at the 3, and the other one is breaking down into 5. We will look at it as we move along. So the next stage is for you to analyze the data. Definitely, you must have the analytical result, etc. The last one is now to develop and communicate your conclusion. And the last one is you have to follow up, update your recommendations as regularly as possible. So let's quickly look at the next one. The next one is talking about financial reporting standards. It's just saying that, oh, this is how the IFRSs were formed. This is how US GAAP. US GAAP is used in United States. IFRS is used in UK and other. So note this, IFRS is more of a principle base, while US GAAP is more of rule base. Let's put it that way. So qualitative characteristics of financial report. there are two fundamental qualitative characteristics. Two fundamentals, which are what? Relevance. That means that the information that you're going to provide must be relevant, and it will potentially affect or make a difference in users' decision. The next one is faithful representation. It means that whatever you are providing, it has to faithfully represent the economic phenomenon that is purported to represent. It has to be complete, neutral, free from errors. Remember, what you are presenting, it is what they are events. They are past events based on a guideline. And the guideline is saying that the information you want to present has to be relevant and has to faithfully represent what happens. That means that it has to complete all the information necessary that you need to provide has to be there. It has to be neutral. Neutrality means that information is selected and presented without bias and free from errors. There should be no errors of commission or omission. So expect one or two questions there. Yeah. So now the next one is now the conceptual framework. It's now saying that what are the 4 things that enhances the quality characteristics of financial statement? Say compatibility. So we should be able to identify and understand similarities and difference of items. Verifiability means that different knowledgeable and independent observer will agree that the information presented faithfully represent the economic event that has happened. It has to be timely, timeliness, and it has to be what? Understandable. So if you like these 4, you can target at your CUTV. CUTV. These are the 4 enhancing characteristics. CU, I see you, TV. C, comparability. U, understandability. TV, timeliness, and verifiability. So if you can put that code there. So when you see a question, and that question does not go with your CUTV, like the one that we saw the other time, accuracy is not there. And accuracy is tempting because it means that your information has to be what? Accurate. But that is not what is in the conceptual what? Framework. All right. So the constraints are cost-benefit analysis. At times, the cost of providing all this might outweigh the what? Benefit. Omission of non-quantifiable information. There must be some information because they are not quantifiable. They might not be what? Presented. So yeah, element of financial statement, you have that is in line with even the accounting equation, right? We say we have asset, we have liability, we have equity. So your accounting equation is asset equals equity plus what? Liability. Like I said, what that one simply says is that for every asset that you have, it must have been financed either through equity or liability. And your income statement, you have your income and your expenses. So there are major 2 assumptions that underline your financial statement. These are the accrual accounting concept. And we have going concern. Accrual means that you should recognize cost, either you have paid for it or not. But when the benefit has been enjoyed, then you need to recognize. Just imagine if the whole accounting world or the whole companies in the whole world have been recognizing or preparing their financial statement based on cash basis. Man, it will have been horror, right? I think accrual concept is the best concept that has ever happened to accounting. Yeah, it might have its drawbacks in terms of some shenanigans, yeah, but by and large, it's serving its purpose, in my opinion. Another one is going concern. It means that you are assuming that you will be in business for the foreseeable future, at least for the next 12 months. That is your going concern concept, right? So what are the measurements that we normally use for our financial statement? Historical cost. Now, this is the cost at which the asset or liability were initially amortized. Cost is when you amortize over the period. We have current cost. We have realizable value. We have present value as of now. That means that you are discounting the future value to present value. And we have fair value, which is the value at which an asset can be exchanged between two knowledgeable individuals, right? Now, let me ask you this, guys. In terms of impairment, what does IFRS say in terms of impairment? Check. Yes. What does IFRS, let me put it that way. What is the first criteria? An asset is impaired when what happens? An asset is impaired when what happens? What will make you to say, oh, this asset is impaired? I'm waiting. Fastest finger, let's see. Carrying value is lower than the net realizable value. Ifunaya, where did you see that carrying value, an asset is impaired? So what you have just said, carrying value is lower than net. I think you are looking at it from the inventory angle. Yes, okay. I'm talking about fixed asset now. Lower of carrying value. The first step is that an asset is impaired when is what? Carrying value is what? Is it higher or lower? Higher or lower than the recoverable amount? Higher or lower, okay? So that means an asset is impaired. Rose, no, an asset is not impaired when the carrying value is lower than the realizable, recoverable amount. No. You see, you guys now? You see? Some people are picking lower, some people are picking higher. Let's try to simplify this. I'm carrying an asset in my books for 2 million. But today, if I want to get a recoverable amount for that asset, it is 1.8. It means that I'm carrying something for 2 million, which is higher than what I can get for it now. That means that that asset is what? Is impaired. So what does IFRS says about recoverable amount? What does IFRS says about recoverable amount? What is the criteria for recoverable amount? What is the relationship between fair value less cost to sell and value in use? What does the standard says there? The area of value in use and fair value less cost to sell. Okay. The area of fair value. Okay. The area of the two. Okay. 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 Pick the area of the two. Okay. So now, guys, can you now see? Don't stress yourself. Just do higher. That means carry value higher than recoverable amount impaired. Recoverable amount higher of value in use and fair value cost to sell. I'm trying to give you some ways in which you can key those things in. Because under exam tension, there are some things that you might even be having a confusing thought on, right? Higher. Carrying value higher than recoverable amount. Yeah. Recoverable amount higher of the two. All right. Let's move on. I'm saying higher, that is carrying value higher than recoverable amount. Recoverable amount means higher of value in use or fair value less cost to sell. Okay, so this is just a general listing of everything that we have said. Your financial statement has what? Balance sheet, which is statement of financial position, our statement of comprehensive income, statement of changes in equity, statement of cash flows, notes, etc. So what are the general features to get this? It has to, so these concepts are the basically features of all these things. Basic concept, it has to have a fair presentation. It has to be prepared on a going concern. If that is the case, if not, then it has to be prepared on a breakup basis. It has to be prepared on an accrual basis concept. Materiality and aggregation, you don't aggregate, yeah. Materiality, there are items that can affect the economic decision. No offsetting, that is, you cannot offset asset and liability. Actually, you can actually aggregate same asset, right? Frequency of your reporting, it has to be comparable. That is, you can put 2 years or 3 years together. Consistency of presentation. Then the structure and content, the balance sheet has to be classified. That is assets, liability, equity, and your asset has to be non-current asset or current asset followed by non-current asset, right? And you also have to have a comparable information, minimum of specific disclosures. And that's that there. Now, let's look at this. Disclosure of accounting policies. So let's look at these differences between IFRS and US GAAP. Who developed this? US GAAP is FASB, right? IFRS, IASB board. US GAAP, like I said, is based on rules, while IFRS is mainly based on what? Principles. Inventory valuation. US GAAP uses LIFO, FIFO weighted average. IFRS is only uses FIFO and weighted average. LIFO is no longer applicable under IFRS. Extraordinary items, you are going to show it below at the bottom of the income statement. This one on IFRS, no segregation in the income statement. You can present it. Development cost. Under US GAAP, it is treated as an expense, but under IFRS, it can be capitalized only if certain conditions are met. Reversal of inventory prohibited. IFRS is permitted if specific conditions are what met. Now, extraordinary items are maybe you sold some of your subsidiary during the year, or let's say there's a LIFO liquidation during the year. So those are anything that is unusual. So we normally call them extraordinary or unusual items. Now, why is IFRS? So now someone is asking why IFRS is principle based, why LIFO not there. So IFRS believes that you should, I don't want to use so much harsh word. I'm trying to put my thoughts there now. Okay, so IFRS is saying, yeah, give people some room to be flexible. Give people some room to be able to do what is right. I don't know if I should say this, but I believe US believes that most of their finance guys are crooks, or let's say because of what has happened in the past, like all the Enron saga, etc. They were saying, guys, no, either this or don't do it. And you know, in US, if a publicly listed company, your CFO and your CEO, they have to sign your financials and send it to this. If there is anything, both of them can go to jail, right? So, yeah, so that's that. Let me quickly explain this development cost, because the point is, I don't know how much time we have, but I want to maximize as best as we can. And at the same time, I don't want to rush you guys. I want you guys to get the maximum thing that you have to. You know, during the course of the year, especially for some industry, there might be some research costs. Yeah. Oh, we want to develop a new product. We want to develop a new this thing. So you can have research cost. Now see, asset is not only the cars, the properties that you have. Your assets can be tangible or intangible. Tangible assets are assets that you can feel and touch. Oh, okay, yeah, I still have to know. Oh, thank you. I was thinking 10:30, Gloria. All right, so yeah, so assets are assets you can feel and touch, like your properties, etc. Then those ones are covered under your IS 16, right? You can choose to do cost-based method or recognition, or you can use fair value, right? However, you have some assets too that you cannot feel or touch, like your goodwill, your license, your brand, and some research costs that you have, because these costs are costs that can give rise to assets. The asset can either be tangible or not, right? So during the course of the year, if you have such cost, US GAAP is saying that. Now see, let's assume that this year, my profit is not that good. It's not great at all. And I've incurred some expense under research and developmental cost, right? Because I still want to present a good profit, I can decide to go and capitalize them. Then I will take those costs off my books. Then it means that my profits will be great. Or in another year, if my profit is too high, and I said, oh, I still want to maintain a particular percentage of profitability, the research and development cost that I can have, I can decide to expense them in that year so that that can reduce my what? Profitability. What we are simply saying is this: if there are no guidelines, number one, it will be difficult for you to compare two companies' financials, because everybody will just be doing everything that they deem fit, right? So that is why we have those guidelines, so that it's easier for me to take a Transcorp financials, compare with another company in the same industry, to see which of the company I'm comfortable with based on my risk tolerance level to invest in, right? So US GAAP is saying that if it's research cost, if it's developmental cost, as long as the asset is not in place, everything expensive. So part of the principle base in IFRS now is saying, yeah, if it's still at the research stage, expense everything. But if at the developmental stage, and you believe that there will be probable inflow of economic benefit, you have the intention to use or sell, the cost can be reliably what? Measured. You can determine the technical feasibility. Okay, capitalize those costs. That's part of the principle. Just like your impairment in US GAAP, if you impair today, you cannot reverse. And that is why there are two stages before you can impair under US GAAP. You have to first of all determine under other disclosure, what do dividends not recognize as depreciation during the period? Yes. Okay, I'll come to that. So you can capitalize. So under the reversal, just the impairment that I'm talking about now, if you have impaired, you cannot reverse. But under IFRS, if there's an impairment, it is subject to reversal, but it has to be at the maximum of the cost or the impairment that you have previously received, right? So Rose is asking a question. She said, under other disclosure, what do dividends not recognized as distribution during the period means? So what you're saying is that there may be some dividend during the year and they are not recognized under distribution. So they might be declared dividend, right? At times during the quarter, if you see a quarterly financial report, or during the year, you might have some declared dividend. So those declared dividend have not been distributed yet. You know, there are layers you declare. When you declare, then that is when You have XDiv, then you now move to the distribution. All right. Let's move on. Understanding the income statement. So your income statement, like we said, it has two things, mainly your income and expense. Your income is majorly your revenue and probably other income. Your other income are just probably some financial instruments, investment that you have. So financial instrument on the Gordon is asking something. He said, what are the ground rules to follow before impairing an asset under US GAAP? Okay, for you to impair an asset, number one, under US GAAP, you have to check between the carrying amount and fair value. You understand? If you see under IFRS, it is carrying value versus recoverable amount. But under US GAAP, it has to be your carrying value versus your fair value. Now, if your carrying value is still higher than your fair value, it means that that asset is what? Impaired. Then there is something we call reporting units under US GAAP. Then what is the amount that you're going to recognize as an impairment under US GAAP? You have to compare the value today versus your implied goodwill fair value. The difference is what you have to recognize as an impairment under US GAAP. All right, so let's quickly look at the revenue. Revenue under IFRS 15 now has 5 steps. Number one, you have to be able to identify the contract with a customer. You have to be able to identify the performance obligation in the contract. You have to determine the transaction price, allocate the transaction price to the performance obligation in the contract. Then you have to recognize the revenue when the entity satisfies the performance obligation. What we are just simply saying is that your revenue has to be what? Earned and realized. I expect the examiner to test you on this because there's some aggressive revenue recognition, that is, those revenue has not been earned or realized. Let's take an example of a tuition house in CFA. The tuition is supposed to run for 6 months. Let's take it that. And the 6 months is between October to March. And the company prepares its financial statement every December. You will agree with me that the company might have earned or realized their revenue for October, November, December. But January, February, March has not been what? Realized. So that means that at the end of that year, what they should be recognizing should be the 3 months. And the other 3 months should be their what? Deferred revenue. That means revenue that has not been earned or realized. However, some companies, because they're having a challenge in here, they might decide to recognize all the what? 6 months, which is against the standards. So these are the key. So we will look at it. What are the things that you should look out for in the revenue recognition of a company, and what are the ways in which some expenses are being what? Recognized. So those are the things. Okay, information can be chosen, include progressive completion. Let me just move on. All right, so you also have to be careful of the depreciation method. We have 2 major types, which are straight line. Straight line is just saying, get your value, divide them by the number of years. You're going to have an equal amount of depreciation every year till the asset's useful life. The other one is declining balance, which you apply a constant rate of depreciation to the declining book value until the value equals residual value. So We also have double decline. You know, it is part of the declining balance, right? So which you have a higher percentage at the earlier years of the company. Now, let me ask you this. In a straight line, these are the kind of questions you should be expecting. In a straight line and in a declining balance method, in the first year of the asset life, which method will give you the higher profitability in the first year or in the earlier years? Which method will give you higher profitability? Is it straight line or is it declining balance? Okay, that's good. That's fantastic. That's good. Okay, that's good. So that means that your profit margin will be higher in the earlier years. So these are the questions you should be expecting in the exam. Now, let's go to inventory valuation. This summarizes it as well. FIFO. FIFO is saying that the cost of earlier items purchased flow to the cost of goods sold. Now, guys, I want you guys to understand inventory reporting in two sides. No, we are from two angles. I will have to record my inventory in my balance sheet and also have to recognize the cost of inventory in my income statement. So that means that inventory sold during the year, the cost has to be recognized in my income statement. And the ones that are left in our warehouses, they have to be what? Put in the balance sheet. So what is simply saying is that FIFO, the cost that I'm going to recognize for the inventory sold should be the earlier purchase. Now, the later ones will form part of my what? Inventory value at the end of the year. What does that mean? I will have a higher inventory value during the year, but a lower cost of inventory or cost of goods sold for FIFO. LIFO means last in, first out. It means that the cost of inventory sold during the year will be my cost of goods sold, and the earlier purchased ones would be my what? End of year inventory values. Okay. So now, let me ask you this. Between FIFO and LIFO, which one will give you more profitability during the year? Assuming an increase in pricing, which one will give you more profitability during the year? Which one will give you more profitability during the year? FIFO. Good, good. Let me now twist this again. Which one will give you lower taxes payments? Which one will give you lower taxes? Lower taxes. Fantastic. These are the questions you should be expecting. Which one will now give you higher cash flow? Higher cash flow. Higher cash flow. Which one will give you higher cash flow? And so we have a mix here, right? Some are saying FIFO, some are saying LIFO, okay? You need to say both of them. All right, so the one that will give you, because you are paying lower taxes, the one that will give you higher cash flow is LIFO. And that is why it is more paramount in US. The US company uses LIFO a lot because it improves their cash flows. Expect that, right? Expect it. All right, weighted average cost is just the middle, right? So now for FIFO, LIFO will give you higher cash flows, yes. For FIFO, we said cost of goods sold when this, I've explained this. Now see, this was the question that I didn't even read properly then. Look at what this is, assume no LIFO layer liquidation. LIFO layer liquidation occurs when the volume of sales exceed the volume of purchase in the period, so that some sales are assumed to be made from existing relatively low-priced inventory rather than from the most recent purchases. All right, so that's the LIFO liquidation that we talked about, right? All right, let's also look at intangible assets with, so now let's talk about this. Let me quickly, I've mentioned assets that you can feel and touch, which are your tangibles, and the intangibles are the assets that you cannot feel or touch. Now, these intangibles too, you have to understand that some will have a finite useful life. That is, they have a time. Like, let's say you have a license or a patent. Yeah, a patent right. The patent right will be given to you for some number of years. The patent cannot be given to you till eternity. So if you want to charge those costs to your books, to your P or L, you have to amortize them over the life of that patent right. So note this, for tangibles, we use depreciation. For intangibles, we use what? Amortization. So you have to amortize over that useful life, you charge it there. That is for assets, intangibles that have a finite useful lives. But we also have some intangibles that have indefinite lives. That is called goodwill. So in that case, your goodwill is not what? Amortized. You don't amortize your goodwill. In that case, your goodwill is not what? Amortized. Some people say they are struggling to hear me. Oh. How about now? How about now? Hello? You can, okay. All right, so goodwill, like I said, is not amortized. Yes, goodwill is not what? Amortized. But the point is they are tested for impairment annually or when there's an indication of impairment. So note that in the intangibles, they can be into two. The ones with finite, useful lives, amortize them over the years. The ones with indefinite, useful life, you have to, or infinite, some call it infinite, some call it indefinite. Then you have to what? Don't amortize. And the only one that all standards are talking about is goodwill. Then all you have to do is you have to test for impairment annually or when there is an indication of impairment. All right. Now, these are some key things that I want you to note. When there's a discontinued operation during the year, discontinued operation, probably you have some of your subsidiaries that you shut down. Let's say you have Dangote now. Dangote sugar is down during the year. They said they don't want to go into that business again. Then we say they have discontinued operations. Then all income from such, their operating income, net of taxes, etc. You have to segregate them because they are not recurring. So you have to segregate them below the income from operations. Like when Rose was asking, okay, somebody asked me, and I said, if tested and there's an indication of impairment, what happens? Then you have to subject it to impairment. So in that case, for IFRS, you have to, so we have what we call CGU, cash generating unit. These are the first set of assets that are going to subject the impairment to. Then if there is still a remainder, then you put it to non-cash generating unit. For US GAAP, you have to first of all subject it to the reporting unit. That was what I explained earlier. But for you to know whether there's an impairment, check it versus your fair value. When there's an impairment, look at the value of the goodwill versus the implied fair value of the goodwill. The difference is the impairment. Under US GAAP, then you apply it to reporting units. Yes, you have to allocate based on pro rata basis after you have subject the impairment to CGU and you still have a remainder. The remainder will now be subject to non-CGU on a pro rata basis. All right, so the next one is unusual or infrequent items. So you have to report them before taxes above your continued operations. Then you have to be able to determine what your unusual or infrequent items are. Then if there's a changes in accounting standard, changes in method applied, corrections or errors. So let me explain this to you. There's something we call ACE, that is ACE. So A means changes in accounting policy. C means changes in estimates. E means errors. That's your ISA, if I'm not mistaken. So what we're saying is that if there's a changes in accounting estimates, these changes are applied prospectively. That means that if in 2022, you now say, oh, there'll be a changes in my accounting estimate, you don't need to look back. You have to apply that change as a 2022 going forward. But if there is a change in accounting standards that you are using, that change requires a retrospective restatement. That is, you have to retrospectively adjust it. All right? And if there is error, you have to also check where the error is, whether it will require a prior adjustment or just going forward. So note all these things. Changes in accounting policies requires retrospective adjustment. Changes in accounting estimate only requires prospective, that is subsequent period adjustment. Operating income is generated from the firm's normal business. For a non-financial, income that results from investing or this is classified as non-operating income. Operating income is what you are going to get from your normal operating business or businesses. However, let's say a Dangote invested in shares, invested in, what is he called? Invested in shares, invested in Transcorp, all those things, derivatives, all those ones are not what operating income. But if you should sell sugar, sell flour, sell this, all those ones are what we called operating. But the investment in the shares and all those things are non-operating events. So if Naya asks himself, are changes in inventory policy LIFO to FIFO also applied retrospectively? So let me ask you this, so that you don't commingle it, right? Accounting policies, it means that the fabric of you reporting that particular item has changed totally. So if you look at LIFO, is LIFO a policy for inventory, or is it an estimate of your inventory? Answer that if Unaya. Policy would define the item. Policy would define, it will give you definition, it will give you the initial recognition, measurement, etc. Depreciation, how to apply for your, how to estimate, this is inventory estimation. All those are not what? They are not policy. If they change, like the way IFRS 39, financial accounting for financial instrument, the way it has changed to IFRS 9, right? That now says that all your categorization of your financial instruments. Financial instruments are basically investment that you have that are less than 10%. How do you classify them? You can classify them in terms of, before, the classification under IFRS 39 was 4. Now it has been changed to only 3. It says that you can only change them from fair value less cost to sell. Yeah, IS 39, yes. It says now it's saying you can only say fair value through profit or loss, fair value through OCI, or what? Amortized cost. And it says that fair value through profit or loss, fair value through OCI are only applicable to equity investment. However, amortized cost is only applicable to what? Bonds, debt instruments, and fair value through profit or loss and fair value OCI. So that means that you cannot categorize any, you cannot classify, let me put it that way, any financial instrument that is equity under amortized cost. And whenever you classify one under equity as fair value through profit or loss or OCI, they are irreversible. This thing touches the fabric of how those investments are classified, recognized, have been issued. So that is what we call changes in accounting policy. The LIFO or FIFO does not change how inventory will be classified. Inventory is still inventory. Assets are still asset. Changes in depreciation methodology, changes in your LIFO or this, they are not changing any of the fabric of how the classification should be or how they should be recognized. They are only estimates. LIFO, we want to use it to estimate what the inventory value will be or what the cost of goods sold will be. So those ones are what we call what? Changes in what? Estimate. However, you can use a note to account, your financial statement note, to let people know, or your investors or users of your financial statement, to know that, oh, there's a change in our estimation of depreciation, in our estimation of what? Inventory. Note that change in accounting policies must affect your definition, must affect your classification, and must affect your recognition. Is that clear? All right. So now, another thing you should be careful about, I'm expecting the examiner to test you on this basic and diluted EPS, how to calculate it, right? Your basic EPS has to be your net income minus your preferred dividend. That is your preferred shares dividend divided by your weighted average number of common shares outstanding. But if it is diluted, you have to look at your net income minus your preferred dividend plus your convertible preferred plus your this. And look at, see, what are we diluting? We are diluting that there are some future shares that can happen. So if you have a convertible preferred share holders or convertible debt, you are telling them that, oh, in future, we can convert your debt or your preferred shares now to pure equity shares. So you have to account for the dividend that we are paying them now, add it to your net income, and also the number of shares that we're likely going to issue them. And that's it. And that's why you see in any financials, you always see the this thing there. Why? I can't see your chart anymore. Let me see. Okay. All right. So I've explained this before. Your balance sheet, it has your assets, your liability, your equity. You have to be careful about the ratios here. You have your current assets, you have your current liabilities. We have what we call working capital ratio. We have what we call cash conversion cycle. And we have your liquidity, your solvency, ability to pay dividend. So look at those ratios. If you don't know them, cram them. I expect 1 or 2 questions from that side. Any questions so far? Any questions so far, guys? Tell me, ask me. Questions? Questions? Are you guys following me? Do you want another quiz? Are you guys, do you want another quiz? Should I just give you like somebody saying yes? Please, more quiz. I can see that you guys are, yeah, it's good. I should expand on discontinued operations. Discontinued operations are subsidiaries. Okay, somebody said I should speak on the diluted earnings per share again. Quiz. Okay. What I can even do is this again. Even if we don't have enough time again, I will probably, guys, but I will make sure as best as I can. Somebody said I should hold the slide for a minute. I will make sure as best as I can. Okay, speak on OCI again. So I have OCI to speak on. I have diluted APS to speak on, and I have discontinued operations to speak on. It's fine. So I'll try as much as possible to compile some quiz, some questions, and I'll send it to the society so that you guys can. And if you have any, I would, so after that, I'll now send the answers after some days so that you guys will not be checking the answers and stuff. So at the end of the day, we can go back. If you have any questions, we can look at that. All right, so OCI is other comprehensive income. Exam is in 2 days. Oh, again. All right, so OCI is other comprehensive income. It's saying that some items might not, because of the standards, they are not supposed to be reported on your income statement. Then they go to your OCI. That kind of thing is what we call dirty surplus. It's outside the scope of your level 1. Clean surplus is saying that all items that gets to OCI must have passed through income statement. So financial instrument, if you have designated a particular investment as fair value through OCI, what it means is that any changes in value of such investment, you will not record it in your income statement. Rather, it goes to your OCI. So that means that it will not be part of your profitability for that year. But if you have designated it to be fair value through profit or loss, that means that unrealized gains, losses, realized gains, losses, everything goes to your what? Income statement. So changes in value, everything, it goes to your profit, income, profit and loss for the year. So that is that. On the discontinued operations, it's saying that there are some operations, there are some subsidiaries, there are some segments, there are some line of businesses that we are saying that we don't want to do again. I think PZ or Woo recently announced that they are no longer going to, we are no longer going to have OMO also, if my memories has me right. So that OMO is not as if it stops now. When they say it stops. No, it will stop production, but they will have inventory of it, right? They will have some wrap-up costs about it, right? So what we're saying is that every income that they get from that line of business, any cost, net them off. Then you present them below your operating income. Operating income are income that you are generating from your present line of business, right? Then you present them there. Now, let me go back to diluted and diluted earnings per share. If you check here, it's saying that what this one is saying is this. Look at earnings per share itself. It's just saying earnings per share, EPS, earnings per share. Earnings that all my ordinary shareholder, as of today, the number of shares that I have in the stock market what is the earnings that they will earn from the profit that I've declared today. But we are saying, yes, that is basic. But in complaints, you might have some arrangements. Let's say we've issued debts, we've issued some preference shares, and we have said that, oh, in 2 years, in 3 years, you can convert all this your debt or all this your instrument to our shares. So that means that in those 2 years or in 2 years' time, the number of shares will go up. What the standard is saying that, oh, let's know what our diluted earnings will be today, assuming they all converted today. Okay, so, but remember, all the interest, dividend that I should have paid them will have been deducted before I get to net income. So I'm saying, oh, if you want me to present that, then it means that all the income, dividend that I've paid these guys, you have to add it to my net income. Adding it means that my numerator will reflect the income that has paid them, which I wouldn't have paid them if they are ordinary shareholders today. Then my denominator will now be the number of shares I should have given to them if I should convert today. And that's it. All right. So let's move to the next one. So we talk about, so we have a cash equivalent. They are short-term investments or your cash that they can easily convert to cash. Remember, your account receivables are reported at net realizable value by estimating the debt, bad debt expense. So it means that if my account receivables today is 2 million, I need to get an estimate for any debt that is irrecoverable, remove them there. That will be my account receivables. Remember, inventory are reported at the lower of cost or net realizable value, lower of cost or net realizable value for IFRS, or for US GAAP is lower of cost or market. Do you get my point? And cost can be measured using our standard costing, just the way that we have talked about, and different cost flow measures like all your FIFO, LIFO, etc. PPE can be reported, I've explained this earlier, can be reported through cost model or evaluation model under IFRS. This is giving you differences in IFRS and US GAAP as well, right? Under US GAAP, only the cost model is what's allowed. Can you see? For your property, plant, and equipment. But under IFRS, you can use your cost model or your evaluation model. Yes, yeah, IFRS is IAS 16 for PPE. Yes. PPE is impaired if the carrying amount exceeds, can you see, exceeds the recoverable amount. Recoverable amount. Recoveries of impairment losses are allowed under UFR, but not under US GAAP. Intangible assets created internally are expensed as incurred. Purchased intangible are reported similar to PPE. Purchased intangibles are like your goodwill. When you buy a company and you pay over the company value, the excess is usually categorized as what? Goodwill. Under IFRS, we've explained this. I'm just trying to brush you up again. IFRS research costs are expensed as incurred, and development costs are capitalized, subject to those conditions that I mentioned. Probable, intention to use us, so probable of economic inflow, probable of inflow of economic benefit, intention to use or sell. Your cost can be reliably what? Measured. You have technical feasibility, etc. But under US GAAP, both the research cost, development cost are what? Expensed under US GAAP. And like I said, your goodwill is the excess of purchase price over the fair value of the identifiable net asset. So goodwill is not amortized, but must be tested for impairment at least annually. Under IFRS, debt security acquired with intention to hold them to maturity are measured at amortized cost. Debt, so this is part of the financial instrument that I've explained earlier, debt security acquired with the intention to collect interest payments, but sell before maturity are measured at what fair value through OCI. Debt security acquired with the intention to sell them in the near term, as well as equity security derivatives are measured at fair value through profit or loss. So those are the three. And this investment are usually the investment that you have less than 10% of the ownership of the company. So now, another thing is IFRS permit to elect irrecoverably at the time of purchase to measure equity security. I've mentioned this under your financial instruments. You can elect either to recognize that equity security as fair value through OCI or fair value through profit, but they are irrecoverable. As soon as you say it is OCI, you can't change it. If you say it's through profit or loss, you can't change it. The purpose is because we want to reduce as best as we can the accounting shenanigans, just like the example that I gave you earlier, right? So under US GAAP, held to maturity security are reported as what? Amortized cost. Trading security available for sale derivatives are reported as what? Fair value. For trading security, unrealized gain loss are recognized in income statement. Unrealized gain or losses for available for sale are reported in OCI. It's similar to IFRS. It's just that it's still using the previous classification of IFRS. So I've explained this too. Your accounts payables are amount owed to suppliers for goods or service purchased on credit. Accrued liabilities are expensed. Are expenses that have been recognized in the income statement, but not yet contractually due. Unearned revenue is cash is collected in advance to providing services. So that means that you have not earned or you have not realized it. Financial liabilities are issued at face value, like bonds payable are reported at amortized cost. Held for trading liabilities, derivatives, liabilities are reported at fair value. All right, guys. So I think here, this just summarizes it. Everything measured at cost or amortized cost, your loans and notes, your unquoted equity in a limited circumstances where you cannot reliably measure them, your debt security that are held to maturity, what are measured through profit or loss or through profit or loss or OCI. For OCI, US GAAP available for sale, debt where their business model for both collecting interest. And so if you want to say this is through OCI under IFRS, there must be two tests. The first one is the model test, and the other one is cash flow characteristics test. The business model test is saying that, basically, I'm doing this just to collect my interest and principal. And your cash flow characteristics is saying that all the cash flow that I'm going to get from this investment are basically coming from interest and principal. That is when you can elect to recognize as or measure at fair value through OCI. If you want to elect for OCI for equity under IFRS, you can do that, but they are irrecoverable. They are irreversible. But measured through OCI, they are every investment you are owed for trading, you want to sell at the immediate etc. All right, so what are the ratios that I've been talking about? You have your current ratio, which is your current asset divided by your current liability. This will signify your ability to meet your current or short-term cash flow needs. Your quick or acid ratio is your cash plus marketable security plus your receivables divided by your current liabilities. This is also your ability to meet your current liabilities. While your cash is everything that has to do with cash or that can be converted to cash at the immediate. Cash plus marketable security divided by your current liability. So that's your liquidity ratio for the short term. For the longer term, You have your long-term debt to equity, which is long-term debt divided by your total equity, while your debt to equity is your total debt divided by your total equity. All these are just measuring your financial risk and what leverage. Your total debt is your total debt, and your financial leverage is your total asset divided by your total equity. All right. We've talked about the ratios. You have your liquidity ratio that we've talked about. Your long-term ratios are your solvency. Your profitability ratios are your gross profit margin, operating margin, your return on capital, return on total assets. Yeah. Now, I expect a question on return on equity, right? So this is the DuPont analysis that I was talking to you about earlier. So the first one is your tree, which is your net income divided by sales. What does this ratio say? Let's just tell me, net income divided by sales. What does it mean? What is the definition of net income divided by sales? Somebody should just let me know. Net income, okay, that's your profit margin, your net profit margin. Now, tell me, sales divided by assets, what does it mean? Asset turnover, okay, asset turnover, good. Total asset turnover. What is your asset divided by your equity? If you remember, I just mentioned it now. Okay, so now, what is your ROE saying? It's saying that your ROE equals your net profit margin multiplied by asset turnover multiplied by your what? Financial leverage. Why am I saying this? In a question, the examiner might have given you your net profit margin and given you your financial leverage. In fact, they might even give you your sales, your total asset turnover, and they're saying what is the return on asset. Stop looking for net income over this, just multiply it. Multiply the tree, and that's it. Yeah, same thing when this tree were now divided into 5. See, there is a flow there. You start with net income divided by your earnings before tax. The next ratio started from the denominator of the previous one. Then it goes up. So I believe if you can remember the first one, net income divided by your earnings before tax, then you go to where? Earnings before tax divided by your earnings before interest and tax. Then the denominator goes back to say about what? Earnings before interest and tax divided by what? Revenue. These three, those three, they are just the ones that were separated or distilled into your net income margin. The net income margin of the first one is just saying net income divided by sales. So they now divided this net income divided by sales into 3. They want to see what is your actual income here, what is my interest burden, and what is my tax burden. That's all. That is what, so it's just divided into 3. So the other one is still the same. Revenue divided by your total asset divided by your what? Total equity. So it's still your net income margin multiplied by your turnover, which is measuring your efficiency, and your financial leverage. So that is why it is not enough for a company to just be reporting good profitability every year. When we are measuring the return on the equity holders, there are other legs. How efficient are you in turning your assets into revenue? That is why you see during the year, I don't know, some of you, the companies that you work for, you will see some companies trying to say, write off some assets or the assets that are no longer technically feasible, and they have a 0 MBV, or they have these, they are writing them off. But the point is, However, if you write off and they still have some MPV still there, it will still affect your what? Net income. So for you to be able to tell your investors that you are giving them a good returns, you have to be financially disciplined. That is what your financial leverage is measuring, yeah? Number two, you have to have asset efficiency. We have to see how are you turning all these assets that you have financed through equity or debt. How are you turning them into sales? Then we have to see how operational efficiency you are through your what? Net income. That is just the purpose of DuPont analysis. You just want to test your asset efficiency, your financial discipline, and your operational what? Discipline. And that's there. So whenever you are doing some ratios too, you can decide to break it down into because something regional analysis, maybe segment analysis, the number of segments that they have, blah, blah. So let me quickly come to taxes. Maybe, I don't know how often, maybe we can wrap up. I don't know whether we're going to wrap up here or not. There's still so much slides here, yeah? But not that many anymore. Okay. All right. So under taxes, there's something I want you to know here. Note this. One of the things that they will actually ask you, it is deferred tax asset or deferred tax liability. Yeah. Now, there's a simple way I normally use to explain this, and that will help you. What am I doing now that is making me pay higher taxes today? Get that? What am I doing now that is making me to pay higher taxes today? And I'll be paying lower taxes in future. That means I have what? Deferred tax assets. What am I paying today? Or what am I doing today that is making me to pay lower taxes today? I'm paying lower today, but I'll be paying higher taxes in future. That is what we call deferred tax liability. I'm deferring it. I'm paying higher today, yes, but I'll be paying lower in future. So that means I have a deferred tax what? Assets. I'm paying lower now. I'll be paying higher in future. I have deferred tax what? Liability. I'm paying higher. I'm repeating it. I want it to stick, right? I'm paying higher taxes now. Higher taxes now. But I'm paying lower in future. I have a deferred tax what? Assets. I'm paying lower now. I'll be paying higher in future. I have a deferred tax liability. Now, let me quickly ask you this. Let's say there's a changes in taxes. Changes in taxes. Let's say it's a drop. Let's put it as a drop. The tax rate when I was paying higher was 20%. Then the following year or so, the tax rate dropped to 10%. What happens to my deferred tax asset? Will it drop or will it increase? Lami said increase. I'm paying higher taxes today. I will pay lower taxes in future. That is what? Okay. Deferred tax asset. Let me repeat myself. This is one of the most confusing topics in your FSA, the heavy one, but I will tell you, if you understand those two sentences properly, I can tell you 90% of your issues under this topic is resolved. Am I paying higher taxes today? Today, now, I'm paying 100, but in future, I will be paying 20. that means I have a deferred tax asset. I have it in future that I'll be paying lower. I have an asset to future. Am I paying lower taxes today? But I'll be paying higher taxes in future. In future, I'll be paying higher taxes. That means I've deferred my taxes to future. I have deferred tax liability. Deferred tax liability. I'm trying to simplify because you will see one or two questions, if not more, in this area. And this is how the examiner will come. You have a deferred tax asset today, and the tax rate was what? 30%. Let's now assume that the deferred tax asset is 100. The following year, that percentage from 30 now drops to 20. Remember, you use 30 to calculate that. So let's say the tax that you are paying today is on 1,000 stuff at 30%. So it means that you have 300 deferred tax assets that will help you in future. They now say taxes has dropped to 20. It means that it will now be 20% multiplied by that 1,000. That means that your asset is now what? 200. So what do you have? You have a decrease of what? 100. Anytime your asset decreases, that is what? An expense to your what? P&L. Understand that, and you are fine. Trust me. So let's now assume there's an increase in tax rate. What does that mean? It means that your asset will what? Increase. Then that will give you profitability in your what? P&L. If you can check Manchester United financial statement, I think about 4, 5, 6 years ago, they reported a huge profit. And this was mainly due to what? Deferred tax assets. Because there was a change in what? Tax rate. These are the things you should watch out for. Now, if I have a deferred tax liability, or I have a liability I'll be paying in future, and the rate dropped, what does that mean? It means that my liability has what? Dropped. It will be an income to your P&L. If the rate increases, it means that my liability has as well what? Increase. Then that will be a what? A cost to your P&L. Does that make sense to you? Whenever you are reading it or you are trying to revise, all you need to do is to what? Understand it from those 2 points. What is this giving us? Will it make us to be having higher taxes now? And I'll be paying lower taxes in future? Then I have a deferred tax what? Assets. Am I paying lower taxes now? And I'll be paying higher in future? Then I have a deferred tax what? Liability. What can make these assets or liabilities to change is the changes in what? My tax rate. If it's making my asset to drop, is an expense. If it's making my asset to grow, is an income. If it's making my liability to drop, is good news. If it's making my liability to increase, is bad news. So now, as a financial strategist, if you are in a country like Nigeria, let me ask you this again. If you are in a country like Nigeria, don't let me use Nigeria. If you are in a country that is susceptible to increase in tax rates, will you likely keep deferred tax assets or liability? Answer me. If you are in an environment where the tax rate is likely going to increase, will you keep a deferred tax asset or liability? Ramat, you said liability. Who else has liability? So that means you want your Enoch. So you want your liability to just be increasing, right? So it's more of asset, right? Okay, guys. So let's see. Let's quickly read through this, what US GAAP and IFRS is. Revaluation of fixed asset and intangible, not applicable. No revaluation is allowed. Revaluation of fixed assets and intangible under IFRS. Deferred taxes are recognized in your what? Equity. So you definitely recognize in your OCI. Now, why? Let's break it down. I revalued my assets today from 100 to 120. So that means that my assets now is what? 120. But in my books, also note that there must be temporary timing difference, right? But my current value is what? 100. Also note that when you're computing taxes, depreciation is what? Allowable what? Expense, right? Do you get? So if my depreciation on 100 is 20, but my depreciation on 120 is 25. Tax people does not recognize revalued what? Amount. They will still take what? 20. Instead of them to take what? 25. So that means that because they are taking 20 now, I will still be paying what? More taxes. But by the time that asset is being sold at the revalued amount, I'll be paying what? Lower taxes. Then that should give you what? A deferred tax asset. So whatever that is making me to pay higher taxes today, but I'll be paying lower in future is what? Deferred tax what? Asset. But whatever that is making me to pay higher now, but I'll be paying lower in future is what? Deferred tax what? Asset. But whatever that is making to pay lower today, I'll be paying higher in future is deferred tax what? Liabilities. So every other thing, look at them in those two sentences window, and I can tell you, you will be fine. All right, so do you all understand that? Does it make sense to you? And that is why I try to keep that, just to keep it in those two things. Look at it in those window. Can we check a question on different? Time is not our friend anymore. I think I have about 10 minutes more. But I can see, maybe I can send it to your group. I will try and see. If I still have time today, I will ask Gloria to send some questions to you on that. So look at it from those two windows, and I can assure you, you will not miss any question on it, and you will enjoy deferred tax asset and deferred tax liability going forward, as long as they are temporary timing was different. Let's look at another example. I have a restructuring cost, and I gave it to tax people as allowable. They said, no, the restructuring has not what? Occur. When it occurs, remember, that is temporary what? Timing what? Difference. So they remove it. They say it's not what? Allowable expense for this year. Now, what does that mean this year? Will I be paying higher taxes or lower taxes? I'll be paying higher. Yes, but when the restructuring occur next year, what will I be paying? Lower. Then that restructuring expense multiplied by my tax rate will give me the what? The deferred tax asset. That's it. That's it. All right, guys. So instead I've cleared the confusion on it. So that is just the two. Forget everything you see on all these things, for any formula, anything. Look at it from those two angles, and you cannot miss it. In fact, it's one of the best topics that you can talk about in FSA, even when you get to level 2, level 3. As long as you have that background knowledge, you will enjoy it. You will not be seeing it as an abstract. All right. Now, a deferred tax liability is what we have explained. I said it's created when income tax expense income is higher than taxable, the deferred tax or core revenues. So just look at that, then you can have that. So Gloria, what do we have next? I know I have a 15-minute window or so to wrap up, but what do we have next? Let me quickly check.
Quantitative methods. That's
okay. That's who?
Ibrahim Salami.
Yeah, so Ibrahim Salami will be coming in the next 12 minutes, right? Well, let me see how.
It's only about 10 minutes we have left, so not 20.
I said 12, Ogayemi. 12. What are you?
Okay, all right.
All right, guys. So I don't like all this. Okay, so let me explain another thing again on bond premium. That's another area of confusion that I want you guys to see. When I have a bond premium means I'm paying higher than the par value today. Discount bond means that I'm paying lower today than the par value. Now, what happens to bond premium? It means that the coupon yield or the coupon rate will be higher than the market yield at the issuance date. What are we going to do? What will actually happen is the coupon is going to be higher than the market yield. The difference of those two is what you will use to amortize the value of that premium bond. That purpose of reducing it is what we call amortization. Let's break it down. Let's say I issue a bond at 107 today. Then the coupon is saying I'll get 10, and the market yield is what? 8. What is the difference there? 2. At the end of the year, the 2 is what I will use to reduce that 107. So amortized value at the end of the year will be 105. That is bond premium. Discount is saying that there will be a market yield that will be higher than your coupon rate. So always check out those two things, the market yield and the coupon rate. So for a discounted bond, it means that the market yield at issuance, when I was issuing that bond, will be higher than the coupon rate. Now, at that time, what will happen? The difference is what you will use to increase it. So let's assume I issue a bond at $80 today, and the market yield is giving me 7, and the coupon rate is 5. The difference is 2. At the end of the year, my amortized value of that bond will be what? 82. Why am I saying this? Anytime the examiner is asking you what is the value, amortized value of a premium bond at the end of the year, the value must be lower. At that end of it must be lower than the initial value that you issued it for. If it is a discounted bond, at the end of the year, the value should be what? Higher than the initial value. Does it make sense? So just like what I've explained, I said for a premium bond, interest expense is less than the coupon payment, of course, because the market is less. So the difference between the interest expense and the coupon payment is subtracted from the bond liability. While for the discounted bond, the interest expense is greater than the coupon payment. The difference in the interest expense and coupon is added to the bond what? Liability. And that's that there, right? So that's one of the area of confusion again that you should be careful about. So another thing, okay, yeah, I think we are done anyways. We are done, yeah. All right, so another thing is on your finance lease, your lease, right? Short-term lease and finance lease. So what you should understand is that except for short-term leases, lessee report an asset and liability on their balance sheet in accordance with IFRS. So both should equal to the present value of the promised lease payment. The interest portion of each of the lease payments is reported as what? Interest expense. While the principal repayment portion of each of the payments reduces the lease liability. But if it is a short-term lease, the rent expense is reported on the income statement and no balance sheet entries are what? Required. under US GAAP, a lease is classified as finance lease if the benefit, risk, ownership has been substantially transferred to the lessee. So it's almost the same classification under IFRS and what? US GAAP, or as an operating lease otherwise. Reporting of a finance lease is the same, just like I said, under IFRS. And for any operating lease, the entire lease payment is recorded as what? Lease expense, while the principal portion reduces the what? Liability. That is for the lessee. But for the lessor under IFRS, the lease can be finance lease or what? Operating lease. Finance lease, the lessor will remove the leased asset from the balance sheet and add the lease as what? Receivable asset. It will report the interest portion as income, but for operating lease, the lease payment as an income and depreciation and other expenses as expense. And for lessor under US GAAP, it can either classify it as sales type, that is direct financing, or operating. Sales type is the transfer of the ownership. It's just like your finance lease under IFRS GAAP. While direct financing is if the transfer of ownership criteria are not met. And for all those things, so a lease is neither sales type nor direct finance lease. If that lease that way, then that lease is called operating lease. All right, guys, I think I'm at the end of it. I'll give you guys 5 minutes break just to take a water break before Ibrahim joins you guys. So I wish you guys all the best. We've talked about all these issues already, right? This is your interest cover, but there to all these ratios. So I don't need to repeat myself, right? But before we go, let's quickly look at the aggressive and conservative accounting. When you capitalize current periodic cost is an aggressive. When you expense them is conservative. When you are using a longer estimate for the lives of your depreciable assets, it means that the depreciation cost will be lower, right? While you are recognizing a higher profit all through those years, right? And when you shorten the lives, that is conservative, right? When you have a higher salvage value is aggressive because that is your denominator, that is part of your numerator, right? It will reduces the value that you need to depreciate. When you have a lower salvage value is a what? Is conservative. When you use straight line, it's kind of aggressive, but when you use accelerated depreciation, it's kind of what? Conservative. When you delay recognition of impairments, just I mentioned this earlier. It's what? It's aggressive. When you recognize impairment early, is conservative. Less accruals of reserve of bad debt is aggressive, but more accruals of reserve for bad debt is what's conservative. What we're just saying in finance, or when you are reporting your FSA, is that we want the bad news as earlier as possible so that it can give people an idea of what will happen in future. Smaller valuation allowance on deferred tax asset is aggressive. Larger valuation on the deferred tax asset is what? Conservative. All right, guys, and that's that about everything. I wish you all the best, Godspeed, and hopefully by the time we're having the level 2 boot camp, I will see most of you guys there. All the best, and have a beautiful Sunday, and have a beautiful exam as well. Thank you so much. Bye for now.
Thank you so much, Shegun. Thank you. Yes, I'm here. Ibrahim is also online, so I think we'll allow like 3 minutes for people to take a water break. Then at exactly 11:30, Ibrahim will take over for quantitative methods.
All right. Thank you.
And they're asking if the slides will be shared. Is this something you want to share with the candidates?
I will send it to you. Hopefully.
Thank you very much, Mr. Chair.
When I'm where I can send. So I'm at the train station actually for 2 hours plus now.
Oh wow.
Thanks for doing this.
All right, guys.
I know how very inconvenienced we were to do it, but thanks for coming through for us and for the candidates.
No problem, guys. All right. Thank you so much, guys. Bye.
Bye, Shegun.
Bye.
Hi, Ibrahim. You can start sharing your screen and just get ready. We have 1 minute.
Yeah, I'm trying to share my screen. Yeah.
Awesome. Okay, so Ibrahim, I'm seeing your screen, so you can
I can't hear him.
I don't think he's speaking yet.
Oh, no, I'm not speaking yet. I'm just trying to. Okay, all right. Good morning, guys. So, hi, Gloria, can you hear me?
Yes, I can hear you. So
you can
they
see
are
my
the candidates. Yeah, are not able to. They will only interact with using the chat box. Yes, I can see your screen as well. Yeah.
Okay. All right. Good morning, guys. So I'll be taking you on the QM. So the QM basically has 7 readings. So you're supposed to know your time value of money, organizing and visualizing data, your probability concepts, your common probability distributions, sampling and estimation, hypothesis testing, and your OLS, right? Those are the 7 readings, right? And we'll just try and look at some basics as in things you really need to know for the exam, right? And we'll try and solve some questions, and that'll just be it. So first reading, which is the time value of money, right? You're expected to know how to interpret your interest rates, right? So your interest rate can be interpreted as rates of return, right? Or yeah, your expected cost, right? It can also be interpreted as sorry guys, it can also be interpreted as your what? Your opportunity cost, So, and it is your interest rates that you use to either compound or discount your cash flow. So the things you are expected to know, you're supposed to know the present value and future value of a single cash flow. You're supposed to be able to calculate that. You're supposed to understand the frequency of compounding. You're supposed to know what your stated and effective rates are. So your stated rate will be your nominal rate and your effective rate will be what you are actually getting. Then you're supposed to be able to understand the present value and future value of a series of cash flow. Then you also be able to differentiate between an ordinary annuity and annuity deal. An ordinary annuity is an annuity where the cash flow comes at the end of the period, which is what you expect. However, you can have an other kind of annuity, which is annuity deal, where the cash flow comes at the beginning of the period. So you're supposed to know how these two types of cash flow affects the computation of your present value and what your future value. Then you're supposed to be able to calculate the present value of unequal cash flows when the cash flow is not constant over a period, where you have changing cash flows, like when you get your dividends, right? It might not come at specific times or might not come in equal amounts. Then you should be able to understand what's called the present value of a perpetuity, right? For example, if you invested in a stock and you're getting dividend for life, or you invested in a perpetual bond where you get coupons for life, right? You should be able to calculate the present value of that. Also, you should be able to calculate present values for cash flows that do not start at time zero, where your time, the time the cash flow started was not at time zero, right? So what are the key things? You should know that what cash flows usually start at the end of the period. So when you are given the cash flow, so if you have your timeline for your cash flow, which looks like this, 0, 1, 2, 3, you should know that what your cash flow starts at the end of the period. So for your first cash flow, it will come at what? Year 1, which is what? The end of the year. So if January 1st was the beginning and December 31st was the end, it will come at what? December 31st, right? So your cash flow is always looking as if it's coming like a period ahead from where you are. So where you are is the present value or the present point, then the cash flow comes at the end of that period, right? At least for ordinary annuity, which is the general form of your cash flow. Then when you're calculating present value, the present value that you calculate using your calculator or your formula, it gives you the value at the period before when the cash flow started. So if I have a timeline, sorry, please. If I have a timeline that looks like this, and I have my time 0, 1, 2, 3, 4, and I have my cash flow starting from year 2, say 50, 50, 50. And I was asked to calculate the present value. If I impute this on my calculator and I calculate the present value, that value I will get for the present value of these 3 cash flows will be what? The value at what? Year 1. So if I'm calculating the present value, I still have to discount that value I get further to what? Year 0, which is where I will actually calculate my real present value. So when you put your data inside your computer and you calculate, the value you're going to get is just the value for the period before the cash flow started. So we still have to discount further to year 0. That is when you don't have your cash flow starting from what? Year 0. Also, when you calculate your future value would be what? The value at the period where the cash flow ended, right? So another example would be if I have my timeline 0, 1, 2, 3, 4, and I want to know and I have a cash flow of 20, 20, 20 for year 1, 2, 3, and I want to know what the future value would be at the end of year 4, right? If I calculate the future value of these 3 cash flows, the value I will get will be at what? Year 3. So I'll have to what? Compound one more time to take it to year 4. So those are the things you need to be careful of when you are calculating cash flows, the present value of cash flows. So you should be able to differentiate between cash flows that occur at the beginning of the period, which is what we call what? Annuity cash flow or annuity due, and the ones that are at the end of the period, which is your ordinary annuity. So if I have a timeline, 2 timelines, and I'm receiving 4 cash flows. So let's say for cash flow 1, 0, 1, 2, 3, 4. And I get 50, 50, 50, 50, right? And for cash flow 2, I have 0, 1, 2, 3, 4. But I get the first cash flow at year 0, 50, 50, 50, 50. These 2 cash flows are different from one another in the sense that one started at the end of the period, one started at the beginning of the period. If you calculated the future values of this cash flow, they should give you 2 different values, right? Or if you calculated the present value because of the timing of the cash flows. And by intuition, the one that the cash flow starts first should have what? The greater value, right? So, which is what annuity due will have what? A greater value than that of ordinary annuity. So like I said, like I explained earlier, if I calculated the cash flow, the present value of cash flow, it will give you what? The value at the period before the cash flow started. So if I did for this first one, I calculated the present value. The value I would get is for what? At year 0, which is what? The present value I'm expecting. If I do for this second one, the value I will get will be for what? The period before the cash flow started. If the cash flow started at year 0, that means the value I will get will be at what? -1. But then if I'm calculating present value, it will be what? At year 0. So I will need to what? Compound back to take it back to year 0, which is why we say that what? The difference between ordinary annuity and annuity due is that what? For present value of an annuity due, it is what? Present value as if it is what? Ordinary annuity multiplied by what? 1 plus your what? Your compounding rate or your interest rate, right? So your present value of annuity due will be greater than your present value of ordinary annuity by a factor of what? 1 plus R, right? And the same for what? Future value of annuity due. If you calculate the future value for this, if you calculate the future value here, it will be what? At year 4, right? But however, if you calculate the future value here, it will be what? At year 3. So we will need to compound a year further to what? Year 4. And that will mean that what? We have to multiply by what? A factor 1 plus R. So you also notice that what? The future value for annuity due is greater than the future value of ordinary annuity by what? A factor 1 plus R. And when you're dealing with calculate present value and future value, you should note the parameters that you need. 1, you will need your present value, you will need your interest rates, you will need your future value, you will need your what? Your payments, and you will need what? Your number of what? Periods. These 5 parameters, you should be able to what? Extract them from every question you are given. And you will need at least 4 of them to be able to calculate your 5th value, right? So, and these are the things you will input in your calculator when you are trying to calculate your future value or your present value or your payment, depending on which of them it's the unknown value, right? Also know that what? You should also understand what? The direction of flow of your cash flow. So you have to use your own a convention. Typically, I advise that you use a convention from the point of view of the investor. So any funds that come into the investor's position should be given as what? Positive, while any funds that leaves the investor's position should be tagged as what? Negative. So that will mean that what? Your present value and your future value cannot carry the same sign because they move in different directions. Your present value would be, if you are investing, will be the amount you are paying out, right? And you'll be expecting to get a future value in future. So your present value will probably carry a negative sign, then you give the future value a positive sign. But then whatever convention works for you is what you should decide to use, but you must stick to it and ensure that what you appropriate, you give the appropriate signs to your cash flow. Otherwise, your calculator will give you what error as the calculation. Also, when you are dealing with unequal cash flow, also, okay, so the payments I mentioned here must be equal payments at equal intervals. When your payment is either not equal by amount or not equal by interval, then the present value function of your calculator will not work. You will have to switch to the cash flow function, right? And discount each of the cash flows individually. And that is what you use your cash flow function for, of the calculator. So you say when you have unequal cash flow, you use what? Cash flow function of the calculator. We will try and solve 1 or 2 questions where we demonstrate the use of these functions, right? When you're comparing 2 cash flows together, I want to know which one is better. You have to evaluate their NPV. So the cash flow with the greater NPV is the one you will choose as an investor, right? That is one that is giving you the net better return on your investable funds, right? So you choose the one with the greater NPV. Also, when you have different compounding periods, so for example, if I was making an investment at 10% per annum, compounded annually, which means that what I will eventually get is still the same 10% because 10% is what? Compounded annually. However, if this was compounded semi-annually, that means I will be paid twice in a year. So the first period, I will be paid what? Half of this 10%, which is 5%. And the second period, I will be paid 5%. But what you should notice is that this 5% I'm paying the first period, that means it's part of my investable funds again, and they'll have to pay me additional 5% on it. So that tells you that the more the compounding period in a year, right, the greater the effective annual rate that you're getting, right? So a quarterly compounding period, we have a greater EAR than a semi-annually compounding period. And a daily compounding period will have a greater EAR than a semi-annually compounding period. The maximum EAR we can have is EAR compounded continuously. So if you have the spectrum, what you have is annual compounding, which will be the least. Annual compounding all the way to continuous compounding, right? So annual compounding, we have the lowest EAR, and continuous compounding, we have the greatest EAR. And as you keep moving along the spectrum, where you have, say, semi-annually, quarterly, daily, weekly, or monthly, weekly, daily, the EAR will be increasing. I will also try and use the calculator to demonstrate this, so you know how to calculate effective your EAR using your calculator. So we said that EAR is the equivalent annual rate if compounded for a single period in a year. That means if I want to be paid just one time in a year, that amount you will pay me for investing a single dollar is what you call your EAR. Then you should know how to convert nominal rates to effective annual rates. Then most importantly, you should know how to use your calculator, right? And that's about the most important thing for the QM, knowing how to use your calculator. And that's going to save you a lot of time in your exam. So the basic formulas, you know how to calculate your future value, which is future value equals to present value times 1 plus R all raised power n. And when you want to calculate your present value, it will be what? Your future value divided by what? The factor 1 plus R raised power n. Then for your present value of perpetual payments, it's what? The payment you are receiving divided by what? Your rate or the market rate, right? And note, this payment is always what? Payments per period. So your payments per period that period must correspond to your N, that's your number of periods. So if I was collecting coupon on a bond for 5 years, paying semi-annually, so that means I'm collecting 2 times in a year, 2 times in a year for 5 years. So each payment will be what? That would be my payment for that half year. Then my number of periods will be what? The 2 times in a year times the number of years, which will now be what? 10, right? So you must be consistent when you are allocating your parameters or your variables. Your payment is what? Payment per period, and your N, number of periods, must correspond to that same period, right? So if you are receiving money for 10 times, then your number of periods must be 10. If you are receiving payment for 20 times, the number of periods must be 20. Your number of periods is not just number of years, it's number of times you are receiving that payment. Then so when you're converting effective annual rate, effective annual rate is what? 1 plus your periodic rate. Your periodic rate is usually what? Your stated rates or your nominal rates divided by what? Number of payments made in a year or number of periods within that year, right? Always for N minus 1. And when you are calculating effective annual rate for continuous compounding, it is what? Exponential, your stated rate minus what? Minus 1, and that will give you your what? Effective annual rate. So let's just try and look at 1 or 2 questions under time value of money.
Hi, Ibrahim. Are you able to look at the chat? There is a question. I think you may want, yeah, from Dipaunia.
Oh, it says, I used to get error 5 anytime I try calculating IY. So, like I said, in your calculation, when you're trying to calculate, right, when you have your parameters, PV, FV, payments, your I over Y, and your what? Your N, right? If what you are trying to calculate is your I over Y, then you have to make sure that what? Your cash flow are appropriately labeled. The signs must go to them appropriately. So for example, if I was an investor that invested in a bond and I'm expecting coupon, so what will happen? Today, I will pay for the bond, right? I will pay for the bond, which will be my what? Present value, the amount I'm paying for the bond. Then I will be expecting what? Coupon from the bond, which will be what? My payment. And I'll also be expecting what? Future value. So this is what I'm expecting. So I will term this as what? Positive, and this as positive. Then I will label my present value as negative because that's what I am paying, right? If you don't do this, you will not be able to calculate your interest rates, because if you put all of them as positive, your calculator will not be able to calculate it. It will give it an error because it will not be able to determine the interest rates that will balance that equation. So like I said, be careful when allocating your signs to the direction of what? Your cash flow. Okay, so let's look at this question. It says at a 5% interest rate per year compounded annually, the present value of a 10-year ordinary annuity with annual payments of 2,000 is 15,443. The present value of a 10-year annuity due with the same interest rate and payments is closest to what? So what they've said is what? They've given you a cash flow for 10-year annuity. And they say it's what? An ordinary annuity. So 0 all the way to what? 10. And they said that what? Each payment is what? 2,000, 2K. And they said the present value of this calculation is what? 15,443.47. Now the question is this: if this were to be an annuity due, what would be the value? Right? So are we trying it? What would be the answer? Like I said, the present value of what? Annuity due is what? Present value of what? Ordinary annuity multiplied by what? 1 times what? R. And we know they've given us the present value of our ordinary annuity, and we know our R as 5%. So, all right, so the class says B.
Yeah, it's okay, sir.
All right, so all we just need to do is what? 15,443 times 1.05, and that will give us what? 16,216, right? Next question. Given a stated annual rate of 6% compounded quarterly, the level amount that's deposited quarterly will grow to 25,000 at the end of 10 years is closest to what? So we are told that what? So now let's put down our parameters. We have our present value, we have our future value, we have our payments, we have our interest rates, and we have our what? Number of periods. So he said that what? Given a stated interest rate of 6% compounded quarterly, that would be what? 6% divided by what? 4, and that would be what? 1.5. That is our interest rate per period. Then our number of period will be what? Number of compounding in a year times number of years, which is what? 4 times 10, because it's 10 years, and that will be what? 40. And they're giving us our future value as what? 25,000. Then our present value, because we assume that what? This is an ordinary annuity, so there is no payment today, right? And that will be what? 0. Then we need to calculate what? Our payment. So its payment we want to calculate. So because it's payment, all you need to do is go to your calculator, allocate your signs. Because now we have just only future value as an amount, right? So future value, you don't have to put a sign here now because that's just only one amount you have. Whatever amount you allocate, sign you allocate to this, if you make it positive, that means what you calculate will come out as what? Negative. So go to your calculator. On your calculator, so first is what? Enter your present value. That is 0. Then you press present value. So you see PV equals to 0, right? If you don't see that PV equals to 0, that means you've not imputed that value. Then next is what? Future value. You enter 25,000 and press your future value, you will see FV equals to 25,000. Payment is what we are looking for. Then next is what? Your I over Y, which is what? 1.5, right? So you impute 1.5 as your I over Y. Then your number of period is what? 40. Impute 40 on your under your end. Then you press compute payments, right? And that should be 461, right? And I've seen lots of responses on that, right? Okay. Let's see. Okay, so let's look at this on equal cash flow. It says the present value of an investment with the following year-end cash flows and the 12% required annual rate of return is closest to what? So you are given this cash flow at year 1, year 2, year 5. Notice there is no year 3 or year 4 there. So what that would mean is that what? You will have to assume values for your year 3 and year 4, and that will be what? 0. So basically what you have is what? Year 1, year 2, year 3, year 4, year 5. Year 1 being 100,000, year 2 being 150,000, year 3 being 0, year 4 being 0, year 5 being what? Negative 10,000. Note, you cannot keep this 0. It's a cash flow because it's happening what? In between the years. So it's just that the value is what? 0. So you cannot keep it. So all you need to do is go to your cash flow function on your calculator, cash flow. The first thing you do when you get to a function is what? Clear any error that is there. So press second function, clear work, and ensure that what? There is no value, residual value you've carried over from previous calculations on your calculator, right? So first is what? Impute. So for your year 0, that means there is no value for your year 0. So your CFO will be 0. So you press enter and go to what? Your year 1. The cash flow for your year 1 is what? 100,000. Once you imputed the value, then you press enter and you will see CO1 equals to what? 100,000. If you don't see that, that means you've not imputed it. Then you press down and you see F01 equals to 1. F01 means that what is the frequency of this 100,000? And that means just once. Then next, you go to what? CO2. What is the value for your CO2? 150,000. You press enter. Then you go to what? FO2, and that should still be what? 1. Then the third cash flow is what? 0. So you put 0 and press enter. Then you see CO3 equals to 0. Now it says that what is the frequency for this? This is 0, and the next one following it 2 is what? 0. That means is what? 2, right? So you input as your F03, you put what? 2 and press what? Enter. Then your next cash flow is what? Negative 10,000. And you press enter. And your F04 is what? 1. Now we've imputed your cash flow. Then you now need to go and impute your what? Interest rates. Next is what? You press MPV. Like I said, if you have anything on your calculator, you have to clear it. Press second function, clear work. So you see I equals to 0. What is the interest rate we are dealing with here? 12. And press what? Enter. Then you press down and compute your what? MPV. And that gives you what? So I'm trying to look at your responses. So are we clear on that? Yeah, so I've seen, okay, Steven asked to slow down. So let's take this question again. Right, so I'll take this particular question again. So you have 3 cash flows, year 1, year 2, year 5, right? You're not giving year 3 and year 4. That means your year 3 and year 4 are what? 0. You cannot just erase the years. Those years exist. So it will be what? Year 3 and year 4, you put zeros there. Now, next is what? To impute your cash flows in your calculator. Press your cash flow function. Once you press your cash flow function, next thing is what? Clear any form of error or any residual value you might have kept from previous work. So you press second function, clear work on your calculator. So you should see CFO equals to 0. And when you press down, you will see your CO1 without any equals to sign. That will mean that what? There is no residual value carried. Next, start imputing your cash flow. So for the first cash flow, 100,000, you impute it and press enter. You will see CO1 equals to what? 1. Then the second, then you press down, you see F01 and you see equals to 1 there. That means it's appearing just what? Once. Then next is what? You press down, you see CO2 and press 150,000, impute 150,000 and press enter. Then you move to what? You press down to F02, which is 1. Then when we come to the third year, you press your what? Cash flow at what? 0 and press enter. You must always see C03 equals to what? 0. But note that what? We have this 0 2 times following each other. And note, they must follow one another. 0 and 0, right? You can't have, if you add 0 as year 3, year 4, I have 50. Year 5, I have 0. I can't count this 0 as following one another. I have to treat each one by one. But because they are following one another in this question, that is why I am counting them what? Together, because they follow after one another. So I will say what? My F02 is what? 1, 2. Then I'll go to the next cash flow, which is CO4, and I will input minus 10,000. Once I've inputted that, I will go to what? My MPV, which is the next button after your cash flow. When you have that, then you calculate, what's it called? You clear it and you input your what? Your interest rate, which is 12. Press enter, press down, and press compute MPV, and you get your what? MPV, right? Which is what? 203,191. All right, let's go back to the next reading. So next reading is what? Organizing and visualizing data. So the things you need to know here, you have to know the type of data you have. You can either have numerical or what? Or categorical data. Numerical are data that are what? Numbers. So you can either be what? Continuous or discrete. Discrete means that what? You probably have limited numbers, right? So for example, number of possible outcomes when you roll a die, you can only have 1, 2, 3, 4, 5, and 6, right? You can't have 1.1. You can't have 2.5, right? That means is what? Discrete. You can count the numbers that you can get, right? That means they are countable. Then for continuous, you can have an unlimited numbers, like infinite numbers. For example, how many numbers are between 1? How many possible numbers are between 1 and 2? There are infinite set of numbers between 1 and 2, because you can have 1.000001, right? So there are infinite set of numbers. Next is what? Categorical data. Your categorical data are data that are what? Not numerical. So your texts, your videos, your pictures, they are all categorical data. But you know, before you can do any analysis, you have to convert all data into what? A numerical form. And how you calculate them, how you can convert them is, you can either convert them using nominal form. So for example, if I have asset classes, or I say types of investable assets, so I could have equity, bonds, cryptos, commodities, right? I can have all of these. These are categorical. What I can then do next is what? Assign numbers to them and say equity is 1, bond is 2, cryptos 3, and commodities 4. So if I have this is what you call what? A nominal form, because this number I've given it is just to describe the class. It's not to tell me which one is better or not, right? So this is what we call what? A nominal data. Or I can have something like this, what's it called? Credit rating, where you have, let's say AAA, BBB, CCC, D, let's just say, for example, right? And I assign 1, 2, 3, 4. Yeah, I know AAA is definitely better than BBB. And I know BBB is definitely better than CCC. And CCC is better than DDD. So this is, apart from the fact that I'm putting them into classes, I am also ordering them, right? By the numbers, I'm giving them order, and that you call what? Ordinal form, right? So before you can analyze your data, your categorical data, you still have to convert it into a numerical form. And in the form of either it takes a nominal form or what? Ordinal form. Then your data can come in 2 forms. It could either be what? A time series, right? When you say time series, that means you are collecting a data over time. For example, inflation over 10 years period. So I have inflation data for year 1, year 2, year 3, year 4, year 5, and I have inflation data. This will what? A time series, because it's inflation over time. Then you can have cross-sectional data. In cross-sectional data, you are collecting variables or a data across multiple points at a single time. So for example, if I was collecting inflation for different African countries for year 2022, so I will have something like this, year 2022, right? And I'll have inflation, I'll say Nigeria, Ghana, Egypt, right? And I'll have their inflation values. And this is what? A cross-sectional data. Time is constant in cross-sectional, but where you're getting the data from is changed. You have different points where you're getting data from. In time series, you are collecting just one data across time. So both time series and cross-sectional are what? One-dimensional data, because it's just one dimension, right? But then there is a third one, which is what? Panel. Here you are collecting different data across different time. So for example, let's say I'm collecting a data that looks like this. For African countries, I'm collecting, say, inflation, GDP, unemployment, right? Across different years. So let's say 2020, 2021, 2022, 2023. So you can see I'm collecting different data across different years. And this is what? A panel, right? So this is what you call what? Panel. And is what? Two-dimensional data, as opposed to what? Time series and what? Cross-sectional data. The third type of thing you look at here is what? Structured versus unstructured data. When we say structured, it means what? Data in what? A tabular form, right? So if I have an array like I drew earlier, this would be what? A structured data. So for example, if you look at the financial statement of a company, you will see where the income statement is, and you see your revenue, you see your costs, profit, and that is what? A structured data. Or when you look at your balance sheets, that's what? A structured data. But when you get to where something like your auditor's notes or what? Director's comments, right? You will see those are words written, story about the company, right? Those are what you call what? Unstructured data, right? And the way you analyze structured data and the way you analyze unstructured data are what? Different. Next is what? How you summarize your data. So one of the ways you summarize your data is what? Using what we call what? A frequency distribution table, right? It said frequency distribution is a tabular presentation of what? Statistical data that aids the analysis of large data sets. So in trying to create a different frequency distribution, what you do is what? You will define your interval, you tally the observation and count the number of observations. Then you will have it in your table. Then you have to know what absolute frequency is. Absolute frequency is what? The number of times a variable appears in the data, right? So that would be what? Absolute frequency. So for example, if I have a data collected that looks like this, so if I say Toyota, Lexus, Benz, oh no, sorry, if I have a data that looks like this, sorry. Yeah. Sorry, let me go again, right? So if I have data that looks like this, and I say number of Toyota is what? 20, number of Benz is 10, and number of Lexus is 10, and number of Benz is 70. This value 70 here is what? Absolute. And let's say I have the last one, let's say I have Innocent IVM and say 100. So the total cars I have is what? So that means the total cars that we have is what? 200. And this speaks to what? Sorry guys, can you hear me?
Yes, I can hear you.
Okay, all right. I'm having a frozen screen here. Okay, all right, it's back up now. So the total we have here is what? 200. And this is what? Your frequency. This frequency here speaks to what? Absolute frequency, the number of times an observation occurs. Then you have relative frequency, which is the number of times an observation occurs divided by what? The total number of observations. So for a Toyota, the relative frequency will be what? 20 divided by what? 200, and that would be what? 0.1. Note, your absolute frequency must add up to what? Your total frequency. And your relative frequency must add up to what? 1 or 100%, right? And the same thing for what? Cumulative absolute frequency. The cumulative absolute frequency will be what? Adding up each of the frequencies. So for here, cumulative absolute frequency will be what? For the first one will be what? 20. For the second one will be what? 20 plus 10, which will be what? 30. For the next one will be what? 30 plus 70, which is 100. And for the last one is will be what? 200. This is your what? Cumulative absolute frequency. However, for your cumulative relative frequency, what you have is what? For the first one is what? Is 0.1. For the second one is what? Is 0.05. That would be what? Is 0.15. For the third one will be what? Is 0.5. And for the last one will be what? 1. And that is how you calculate your what? Cumulative relative frequency. Then you have a contingency table. A contingency table is described as what? A two-dimensional array with which we can analyze two variables. For example, I want to know the number of cars that ply a road on a particular day, right? So I will probably have different cars, let's say, like I said, Lexus, Toyota, Benz, and I have Monday, Tuesday, Wednesday, right? So this is what? A two-dimensional data. I'm having two variables. I'm having cars and I'm having what? Days. So if on Monday there are 20 Lexus, on then 30 Toyota and 50 Benz, then on Tuesday, say 10, 5, 35, then let's say 15, 10, right? And we say each of these frequencies for this relates to what? Number of Lexus on Monday, right? And we call it what? A joint frequency, because it's what? Number of Lexus on Monday. This 5 here is what? Number of Toyota on Tuesday. So we call it what? A joint frequency. But if you want to know the number of Lexus in total, it will be what? 20 plus 10 plus 15. And that will be what? 45. And this is what? Total number of Lexus. And this is what you call what? Marginal frequency, because this is for Lexus alone. If I want to know number of cars on Monday, that will be 20 plus 30 plus 50. And that will be what? 100. This is what? 100 number of cars on Monday. And that is what we call what? Marginal frequency. But when I'm relating to things within the array, the dimension itself in the box is what? Joint frequency. So you have to differentiate between joint frequency and what? Marginal frequency. Then a confusion matrix is what? A 2x2 contingency table, right? So what I have for a confusion matrix is something that looks like this, where you are trying to compare actual versus predicted. So let's say I say a bond will what? Default versus what? Not default. And predicted will be what? Default versus what? Not default. So question here is this. Let's say I have 100. Let's say this is, say, 50, 30, 20, and say 100, right? What this means is that what? I predicted that what? In total, 70 bonds will default and 130 will not default, right? And that is what actually happened. This is the actual. But what I predicted was what? 80 will default and 120 will not default. So this is what a confusion matrix look like. All you just need to do next is what? Compare how many defaults to not default, right? So they can tell you to fill in the box. They can remove, maybe this 20 is missing, and they tell you to fill what the value is going to be, right? Or they ask for what is the total number of actual defaults. Then you have to sum it up, right? Those are the questions you can get. Next is what? Organizing and visualizing data. How do you visualize your data? So this is about data presentation. So you use histogram. Histogram looks like this, like they are similar to bar charts. They are similar to bar charts. You plot the what? Either the interval against what? The frequency. Then you have your frequency polygon, where you plot your what? Midpoint against what? Your absolute frequencies. Then you have your cumulative frequency distribution, where you plot your what? Midpoint against what? Cumulative absolute frequency. You can also have cumulative relative frequency, where you plot your what? Midpoint against what? Cumulative relative frequency, right? And your cumulative absolute frequency and your cumulative relative frequency will have what? The same shape. Also, you have bar chart. Like I said, bar chart is very similar to histogram. It's just that there's spaces in between the bars, right? That's just the difference. And you can have types of bar charts. You can have a group bar chart, or you can have what? A stacked bar chart, right? So for example, if I was having something like number of people that wrote exam, let's say they are 100, and there are 60 female and 40 male that wrote the exam. So I can show it separately like this. Oh, number of people that wrote the exam, 60 female, 40 male, right? Separately. Or I could show it as number of people that wrote the exam. I could have 100 and I have what? 60 as female, 40 as male. This is what we call what? A stacked bar chart, where you will plus everything, you consolidate everything in a single bar, right? And that's what stacked bar chart. Then you can have your tree map. Your tree map is used to show two things. It shows its relative size and what? Maybe returns. For example, I'm sure for those of us that follow maybe foreign equities, where you have something where you can get, so if I want to look at, let's say I have something like this. Let's say this is, say, NAS 100, for example, NASDAQ 100, and I have, say, Apple here, and I have, say, Tesla, and say Netflix, right? And I have these three. What this three guys say, I say, and for the day, let's say the return for Apple was, say, 5%, and the return for Tesla was, say, maybe 3%, and the return for Netflix, let's say, negative 2%. So this thing is going to show us things like, so I can decide to color this as green, right? Then I color this as, say, a lighter green. Then for Tesla and Netflix, that is negative, I color it red. Right? So, but this size of each of these boxes shows us the relative size. So that means that, let's say the total size for this market is 100. From this shape, this takes almost half of it. And this takes, like, let's say, I would say Apple is like 50% of the market. Tesla is like about 25%. Then Netflix is about 25%. So you can see tree map shows two things. It shows relative size and also show what? Return. So you can know when to use a tree map. Then word cloud is basically used for word count, something like when you have something like this, like trending data, you have Apple, and you have other small, this maybe you say Tesla. Maybe you are reading a text and you want to know which word appears the most, right? Then you have line charts, dual line charts, bob charts, those will show what? Maybe comparison or relationship. Then you can have scatter plots, which can also show relationship. Then you have heat map. Heat map is similar to tree map, but heat map only shows one variable, maybe return, and you want to probably compare return over a period, right? And you have something like this, and each one will have a different color just to show the returns in it. How do you select the best data visualizing data to use? If you are showing relationship, you should probably use scatter plots or line charts. If you are doing comparison, you should use bar charts, tree map, or heat map. If you are trying to show distribution, maybe histogram, frequency polygon, or cumulative distribution, right? Then you should know your central of tendency, measures of central tendency. That is your mean, your median, your mode. Your mean is like your average, your median is the middle number, and the mode is what? The most occurring data, right? The one with the highest frequency. Then also that concept of mean, you could calculate your geometric mean, which is you multiplying all your data and finding the end truth. Or when the data has anything that is below 1, you calculate it by what? Adding 1 to each of the data, as this formula shows. Then you add 1 to it and calculate and solve for it, right? So this is for geometric mean, right? Then you can also have trimmed or Windsorized mean. By trim mean, we mean that what? You remove outliers. So you can have a 1% trimmed mean. So you remove 0.5% upper outlier and 0.5% lower outlier. Then you find the mean of what is left. Then you can also have Windsorized mean. In Windsorized mean, the difference between Windsorized is that the outlier you remove, you will replace it back with an expected value, right? That's the difference between trimmed and Windsorized. In trimmed, you remove completely. In Windsorized, you replace back with a different value. Then your quantiles, which shows your location. You can have quartiles, which talks about 25 percentiles. Your quintiles, which is what? 20 deciles, 10%. And you can have your percentile, which is what? Differences in 1%. Then you'll be able to tell your what? Measures of dispersion, your range, which is what? Difference between the largest value and what? And the lowest value. Then your mean absolute deviation. Because your deviation itself, if you find deviation, which is how dispersed your data are from the mean, if you found the deviation, it will be what? 0 if you found the deviation. So what we do is what? We find absolute deviation. So if I have a data that looks like this, 3, 4, 5, the mean will be what? 4. If I was also to find the deviation, this would be what? -1, 0, and 1. And the deviation would be what? 0. What I would do is in what? Absolute deviation. Absolute deviation will mean like what? This is 1, this is 0, and this is 1. And when I find the absolute deviation, this will be what? 2. Right? That's what we are saying. Then variance, population variance, and population standard deviation. Your population variance is calculated as what? Your mean, your data minus your mean, all square, summation of your data minus your mean all square divided by what? N. This is for population. And if it's for sample, it will be what? Divided by what? N minus what? 1, right? Then next is what? Coefficient of variation. Coefficient of variation measures what? Your risk taking per 1 unit of what? Return. It is a relative measure, right? What you used to do is what? You use it to compare. And you will choose what? The one with the lower coefficient of variation, because it's a measure of risk. How much risk you are taking per a unit return. So you will take the what? The one with what? The lower coefficient of what? Variation. Right? Then your data in skewness, we said what? Your data, if your data is symmetrical, and we said that means that what? It does not have any skewness. But you can either have positive skewness, where your data has more positive values than negative values, right? And your data will look something like this. Something skews to the right, right? You have more positive data than you have negative data. And this is what as an investing manager, I would prefer a positive skewed data, which that was my chances of getting positive returns is better than getting negative returns, right? So as an investor, I would prefer a positively skewed data. And in positively skewed data, your mean will be what's greater than your median, which in turn will be what's greater than your what? Mode. That is positively skewed. But in negatively skewed, your mode will be greater than what? Your median, which is what? Greater than what? Your mean, right? That is the arrangement. So it will look like this. Something like this positive. This is positively skewed. This is your normal data. And this is your negatively skewed. Will look something like this. Right? And that's it. Then kurtosis. Kurtosis speaks to about the height or the concentration of your data. So you could have a data that is probably concentrated either in the middle, something like look like this. That means it has this one, you say what has what? Fat tails. So it's concentrated at the tails and it has fewer data in the middle. And we say this is what? Leptokurtic. Or you can have one that is what? Fewer tails or very wide center. And this is what we call what? Platykurtic. And you could have the third one that looks like your normal distribution, and that is what? Mesokurtic. Right? We'll look at correlation later. So we'll try and look at questions, but there are not too many questions here, but when we get there, we'll look at questions here. So let's move to the next reading. So let me see chat. Any questions on the chat? Okay, I can't see any question. So let's move to the next reading, which is what? Probability concepts. So under probability concepts, you should know what an event is. We said an event is what? A specified set of outcomes. You should know that what the probability of an event will lie between what? 0 and 1, and the sum of probability for all mutually exclusive and exhaustive events should equal to what? 1. You have 3 types of probability. You can have subjective, empirical, and priori. Empirical is probability gotten from data. Priori is probability from what? Logic. While subjective is probability from what? Intuition. Both empirical and priori are what? Are described as what? Objective data, right? Objective. Both empirical and priori are what? Objective. Then you should know how to get odds for an event. In probability, the odds for an event is what? Is the probability of that event over 1 minus what? The probability of the event. So for example, if I say the probability of getting, that what are the odds of getting 2 when you roll a die? So when you roll a die, there are 6 possible outcomes. 1 to 6, right? And I say, what's the probability of getting a 2? The probability of getting a 2 be what? That is 1, because 2 only appears once, right? That is 1 over what? 6. If I now say, what is the odds for getting 2? It will be what? The probability of getting odds of getting 2. And that would be what? The odds for getting 2 will be what? 1 over what? 5. And this will be the what? The odds of getting 2. Because this is the chances that support getting 2 one time, and there are 5 other outcomes that does not support you getting 2. And this is how you describe what? Odds. Right? Then unconditional probability is just that probability statement. If I say what's the probability of getting a 2, that's what you call what? Unconditional probability. It is not tied to anything happening. However, conditional probability is probability that is tied in a die if I get edge in a coin. So now I'm making the probability of getting a 2 conditional on me getting edge when I toss a coin, right? And that's what? A conditional probability. The multiplication rule for probability. So if I have probability of what? Probability of A and B. It is that what? What's the probability of A and B occurring together? And that will be that what? The probability of A occurring given that what? B has occurred, multiplied by what? The probability of what? B occurring. Right? This is the multiplication rule for joint probability. And you will note that what? The probability of what? BA, which is same thing as probability of AB, because both of them are occurring together, is what? Probability of B given A, multiplied by what? Probability of A. This is very important and fundamental in your probability, especially when you get to either total probability rule and what's it called? Bayes formula. If you know this basic equation, that probability of AB is equals to what? Probability of BA. You can be able to derive your Bayes formula from here straight up without any confusion in the exam. Then additional rule for probability. Additional rule for probability is what's the probability of A or B? That means probability that either A or B will occur. We say what? Probability of A or B. So it will be what? Either probability of A occurring plus probability of A and B occurring together, right? If A and B are mutually exclusive, which means that they cannot occur at the same time, then your additional rule will just simply be what? The probability of A or B will just be what? Probability of A plus probability of B. That is when A and B are what? Mutually exclusive. That means they cannot occur at the same time, right? Because then probability of AB will be what? 0. So those are the things you need to know. Then multiplication rule for independent events. When we say independent, we mean that what? Their occurrence does not depend on one another. So, example, the probability of me getting head or tail when I toss a coin does not in any way influence if I get 1, 2, 3, or 4, 5, 6 when I toss a die or when I roll a die. So we say these two events are what? Independent. They don't influence each other. So for that, then your multiplication rule, which we wrote earlier, as probability of A, B, which is what? Probability of A giving B multiplied by what? Probability of B. We now reduce to what? Probability of A multiplied by what? Probability of B. Because probability of A giving B is same as what? Probability of A when they are what? Independent. Next is total probability rule. Under total probability rule, we say we try to use what? Conditional probabilities to be able to determine what? An unconditional probability. Right? So you're trying to use conditional probability to determine what? Unconditional probability. So example, let's say I say there's going to be either recession or no recession, right? Then I say if there is a recession, GDP may go up, and no, let's say interest rates increase, interest rate decrease. Then if there's no recession, interest rates increase, and what? Interest rates decrease. So if I want to know the unconditional probability of interest rate increase, which is what? Probability of what? I. That is the unconditional probability of I. How would I get this? This would be what? The conditional probability of interest rates increase, given that there's a recession, plus the conditional probability of what? Interest rates increase, given that what? There is no recession. And that would be what? Equals to what? The joint probability of what? Interest rates, recession, and interest rates and what? Plus what? The probability of what? No recession and what? Interest rates. And that you can always solve for that to give you what? So this would be what? The probability of interest rates given recession multiplied by what? Probability of recession, right? Plus probability of what? Interest rates given no recession multiplied by what? Probability of what? No recession. And that's how you determine total probability rule. We'll be able to solve questions on this and demonstrate it using actual figures. Next is what? Portfolio expected return and variance. So I'm just saying that if you want to calculate the expected return of a portfolio, so if you have a 3-asset portfolio, A, B, C, and you have their returns, say 10%, 20%, 30%. If I want to calculate the expected return, I will need the probabilities of these returns, right? So when I know the probabilities of each of these returns, I will now use it to multiply the expected return, then add it up, right? And that's how you calculate what? The expected return of what? A portfolio. So we use, it's just like you calculating weighted average. But now, instead of using relative frequency as your weight, what you'll be using as your weight now will be what? The probability, right? Then when you're calculating your portfolio variance, okay, so for a multi-asset portfolio, you will need a covariance matrix. So when a covariance matrix helps you to determine or to visualize the number of covariance terms, right? So for example, for a 3-asset portfolio, you're going to have a total number of what? 9 covariance terms. Out of this 9, you're going to have what? Hi, Gloria.
Hi, Ibrahim. I can hear
I'm trying
you.
to check. Yeah, okay. Once I get a freeze on my system, I just try to check if I'm still.
Okay.
On the
I can
site.
still hear you. Yeah.
All right. Okay, so what am I describing? So your covariance terms. So let's say for a 3-asset portfolio, you're going to have a covariance matrix that has what? 9 terms. Out of these 9 terms, 3 are what? Variance terms. Then the remaining 6 are what? Covariance terms. But of these covariance terms, they can be divided into what? 2 equal parts of 3, 3, right? So what you need is what? So when you ask you questions like how many unique covariance terms are there? So to get the number of covariance terms, it is what? N squared minus N. N squared being the total number of terms you can have. Then N being the number of variance terms itself. So if I have a 4-asset portfolio, my total variance terms will be what? N squared, and that would be what? 16. Then my covariance terms will be what? N squared minus N, which is what? 16 minus 4, and that would be what? 12. Then my unique covariance terms will be what? N squared minus N divided by what? 2, and that would be what? 6, right? And like you have known, it's not so easy to interpret covariance. So what we try and do is what? Try and interpret correlation. And correlation is simply what? Your correlation is simply what? Your covariance. So your correlation between, let's say, assets A and B is just your covariance of A and B, divided by what? Standard deviation of A and standard deviation of what? B. And that's how we get your what? Your correlation. Your correlation ranges between what? -1 to +1. -1 means that what? They move in opposite direction relative to what? Their mean position. That means when one is going up, the other one is what? Going down, right? +1 means that what? They move in the same direction. We both are going, but in between, they have what? Relative direction against one another. So any negative means that what? They are moving in different direction. Positive means that what? They are going in the same direction. And when it is 0, means that what? There is no observed or observable relationship between them. What are the limitations of correlation? Correlation does not mean causation. And sometimes you can have what? Spurious correlation. Then sometimes you can have a correlation, but it might not be linear. So you won't be able to, there might be a relationship that is not linear, and correlation will not be able to determine, because correlation is what? A linear measurement. Then next is what? Bayes formula. You say what? Bayes formula is what? Probability of what? Learning from experience or updating prior probabilities. And it's just simply what? If I ask myself that the probability that there will be traffic when it rains, now what is the probability that there will be traffic when it rains, right? I know that there will be traffic when it rains, right? It's just simply what? The probability that it rains, given that there's traffic, divided by what? The probability of it raining itself, multiplied by what? The probability that that there is traffic. So all we're just trying to do with Bayes formula is that we are just updating a prior information. If you notice this part here, all we are comparing is what? A conditional probability of when it rains, given that there's traffic, as against the unconditional probability of what? Just raining. Then we are updating the unconditional, or what you call what? The prior probability of them being traffic to when, oh, it rains. So example is that what? Let's look at it like this. Let's look at it using a tree diagram. So it can either be rain and there's traffic, and no rain, sorry. Then when it rains, there can either be traffic or what? No traffic. Then traffic or no traffic. So you're not, what they're asking is that what? Once you know that it has rained, what would be the probability of what? Traffic. So we use a question to demonstrate this, right? And it will be clearer when we solve a question on that. Next is what? Principle of counting. And like I said, under base formula, when you know, if you don't remember this formula, right? If you know your joint probability formula of probability of what? AB, which is equal to what? Probability of A given B, multiplied by what? Probability of B. Then probability of what? BA is what? Probability of B given A, multiplied by what? Probability of what? A. If I equate these two together, all I will have is what? Probability of A, and I make probability of A given B, my subset of formula, then this would be what? Probability of B given A, multiplied by probability of A, divided by what? Probability of what? B. And you can see this is just your base formula, right? So learn how to move on your base formula. The multiplication rule, counting rule. So when we are dealing with probability, you have to be able to count. The first one is what? Labeling. If I have 10 items and I want to divide it into 4 groups, in how many possibilities will I divide them? So let's say I have 10 items and I want to divide it into 4 groups of 1 to 4. So that will be my K. So I can group them into 4K. So I will have what? N factorial. So I have, so let's say I have it like this. So let me make it more clearer. So let's say I have 10 items and I want to put them into 4 groups. Group 1, 2, 3, and 4. Group 1 can take just 2. Group 2 can take 2. Group 3 can take 3. And group 4 can take 3. And I want to share this 10 into here. And what I'm saying is that what? How many ways can I share it? It will be what? 10 factorial all over what? 2 factorial, 2 factorial, 3 factorial, 3 factorial. Note, if I add what is below down, it must also equals to 10. That is 2 plus 2 plus 3 plus 3 must also equals to 10. And that's how we determine your what? Labeling problem. But a unique labeling problem is if I'm just dividing it into 2 groups. So if I want to share this 10 into just 2 groups, group 1 and group 2. Here, group 1 takes 7 and group 2 takes 3. So I'll have something that looks like this. 10 factorial over 7 factorial, 3 factorial, which is the same thing as what? This 10 being my n factorial over n minus r factorial, then what? R factorial. And this is what you call what? A combination formula. So you have just 2 groups. That means if it doesn't fall in group 1, then it will fall in group 2, where the order does not matter, right? Where the order does not matter. But when the order matters, then this reduces to what? A permutation formula. Then you have what? N factorial over n minus r factorial. What you notice is this. Permutation will give you more possible outcomes than what? Than combination. And you can always see these functions on your calculator. So let's try and move faster. So, okay, so I will just try and run faster on this because I want to get to the more important topics, or let me just keep to a much more important topic. Then I'll come back to that if I can get to that. Sampling and estimation. One of the things we know that is very important in statistics, in QM is what, or in our life activities is what? Sampling. Because we cannot evaluate the total population, so we have to what? Take samples. So we have two types of sampling. You can either have probability sampling or what? Non-probability sampling. In probability sampling, we deal with what? We have examples like simple random sampling, systematic random sampling, stratified sampling, or cluster sampling. The difference is that what? In simple random sampling, you're just choosing at random, right? In stratified, you are trying to what? Still retain the strata or the structure of your population. Whereas in cluster, all you're just doing is that what? You're just picking a group and you're analyzing just that group alone. Then in non-probability sampling, we are looking at two types. Could have either convenience, which would be what? Sampling based on what? Availability of data, or judgmental sampling, which is sampling based on what? Experience. And you will see auditors do judgmental sampling a lot. If I was an auditor and I was going to audit, say, a bank, because I've done previous audits, I know the troublesome parts, so I will know where to go and audit, right? I won't just pick at random, right? And that's when judgment comes in. The next is what? You should know what your sampling error is. The sampling error is what? The difference between your sample statistic, that means the statistic you calculated using your sample, and what? Your population parameter, what exactly you are trying to what? Estimate. So for example, for a mean, it will be what? Sample mean minus what? Population mean, which is what? X minus what? Mu. And that will be your what? Sampling error. Then you should know your what? Central limit theorem, which is what? Very, very important. The central limit theorem is very important. And the central limit theorem says that what? Given a population with any probability distribution, having mean of mu and what? A finite variance, right? If n is sufficiently large, the sample distribution of the mean of the samples n will have what? Approximately normal distribution with mu and variance of what? Variance over n. All you're saying is that what? When you do a sample distribution of your sample, at the end of the day, the mean you will get, your x, must be equal to what? Your population mean. And your variance will be what? Your population variance divided by what? N, right? For the sampling distribution, and that's what it's saying. When we say sufficiently large, we mean that what? When your N is what? Greater than or at least equals to what? 30. That's what we mean sufficiently large, right? Then if you want to calculate your sampling, what's called standard error. The standard error is just simply what? The square root of what? Your sample variance, right? I mean, sampling variance, which is this, the square root of it, and that will be what? Standard deviation divided by what? Square root of what? N, and this is your what? Standard error. Next, you should know what? The properties of what? Your estimator. We said that what an estimator is what you use to estimate the population parameter. So for example, sample mean is what? Estimator for population mean. How do you know what are the characteristics of a good estimator? We say that what? It must be what? Unbiased, it must be efficient, and it must be consistent. By unbiased, we mean that what? Your sample, your estimator must equal to what? To the value it's trying to estimate. So for example, here, we say that what? Your mean must be equal, your sample mean must be equal to what? Your population mean. And that means that what? It is unbiased, right? By being efficient, we say that what? The variance, your estimator must have what? The least variance of all unbiased estimators. So if you have 10 unbiased estimators, the one with the least variance will be the what? The most efficient one, and that's the one you should choose. Then it must be what? Consistent. By consistent, it means that what? As you keep increasing your sample size, your estimator becomes what? More unbiased, and it also becomes what? More efficient. That means it becomes more equal or more accurate, and it becomes what? The variance also becomes what? Smaller, right? Then confidence interval. How do you build a confidence interval around a value? You say that what? You use what? The value you are given, or which is usually your mean point estimate, plus or minus a reliability factor times what? Standard error, right? And this is how do you get your reliability factor? You get your reliability factor by reading it from your chart, either your student T chart or what? Your Z chart. And that's where you're using your what? Level of significance or what? Your confidence level to read the chart. Then you multiply by what? Standard error. The standard error, as you said, is calculated here. If you know the population variance, but once you don't know the population variance, you can use what? The sample variance or the sample standard deviation to calculate your what? Standard error. Then you should know the properties of your distributions. Let's see. You say your Z distribution is what? Is a normal distribution, right? It is symmetric. That's your Z. It is normal. It is symmetric. Your student T is also symmetric, but it has a bit of kurtosis in it. But at higher sample sizes, your student T approaches your what? Your Z, right? And it also has what? A degree of freedom of what? N minus 1. And we say that what? As N, your sample size increases, your student T tends towards what? Your Z or your normal distribution as your sample size increases. When do you know when to use your Z or T? Right? Based on this chart, you can know when to use your Z or your student T. When you have a normal distribution and you know your population variance, then you use your Z. When you don't know your population variance, then you use your T. Then in between the two, you can decide which one to use. But when your population variance is unknown and your sample size is also small, and your distribution is not normally distributed, then you cannot use either Z or T, right? As stated here, right? But what you should have at the back of your mind is this. Do you know your population variance? If the answer is yes, then your answer is tending towards what? You using Z. If you don't know your population variance, then you are tending towards using T, right? That's what you should have at the back of your what? Mind. Right, so let's look at issues you can have with sampling. You can have data mining, which means that you keep using the same data and you're calling data snooping. You're looking at the same data over and over again just to get a desired result. Then sample selection bias can be caused by what? When you are limited by the kind of samples you can take, right? You can have what? A sample selection bias. Survivorship is what? When you're only estimating or evaluating data from what is currently available or things that have survived and you neglected the ones that are gone past. So for example, if I was evaluating a loan book and all the people that have paid down on the loan book, I don't include them. The only thing I'm looking at is people that are currently in the loan portfolio. That is what? A survivorship bias. Or if you're evaluating a mutual fund or a stock exchange and all the stocks that have closed down and they have been maybe removed from the exchange, you're not including them in your evaluation, then you could have what? A survivorship bias. Look ahead bias is when what you are using to evaluate is not currently available at the time of your evaluation. A very good example is your what? Your PE ratio. Your PE ratio. Your PE ratio for the end of the year, we have what? The price at the end of the year against what? The earnings at the end of the year. But at the end of the year, you won't have the information for the earnings because the earnings will not released until like 2-3 months after. But then you'll have evaluated your PE ratio at the end of the year. So this is what we call a look ahead bias. You are estimating a data that is not currently available. Then time period bias is when you limit your data based on time, right? So if I say, oh, I want to look at how men have performed in 100 meters race, and I say I want to start from year 2000. Question is, why am I looking at year 2000 and myself? What happened to people that have run before year 2000? Why am I not including them, right? And that's what a time period bias. Then let's look at resampling. Reason why we do resampling is to improve what? The quality of our what? Sampling, right? And we do what we call what? Either bootstrapping or jackknife. In bootstrapping, let's say I'm trying to select a sample. Let's say I have 10 data. I have 10 data. I'm trying to pick 5 samples from it. What I would do in bootstrapping is I'll pick the first 5. When I pick the first 5, then I will return it. I'll pick another 5. When I pick another 5, I'll return them again. I'll pick another 5, and I'll keep evaluating them. At the end of the day, I'll find an average. However, in jackknife, what I do is when I pick the first 5, the sample from the first 5, I will not return them. For example, let me use a bigger value. Let's say I was trying to pick, I have 100 population, and I'm trying to pick a sample of 5. So let me go over it again. In bootstrapping, when I pick the first 5 from this 100, and I evaluate it, I get my sample mean. I will return this 5 back, so I will have 100 again. I'll randomly pick another 5 again. I will evaluate that and return it. Then I'll randomly pick another 5. I will evaluate and return. So at any time I want to pick, I must still have 100, right? But in jackknife, once I've picked the first 5, I won't return it. So I'm left with what? 95. Then I'll pick another 5 from this 95. Then I'm left with what? 90. Then I'll keep sampling till there's nothing more, and I'll evaluate. Question is, which one of it is better? Bootstrapping is better, but it's much more what? Complicated, right? These are the things you need to know. Next, let's look at hypothesis testing. So hypothesis testing, let's just look at the general things you need to know under hypothesis testing, right? You should be able to know what your null hypothesis is. I would say your null hypothesis is what? Your null hypothesis. It is considered what? True, which is what? Your H0. It is considered true unless evidence suggests otherwise. It is the hypothesis to be tested. It is the hypothesis you would want to reject. So when you are defining your null, you have to note, it is very important that you get the definition of your null hypothesis very correct. Otherwise, you won't get the correct answer, right? Next, your alternate hypothesis. Your alternate hypothesis. You say what? Alternate hypothesis is what? Is what? Also the alternative hypothesis, or what? It's also the what? The complement of your null, right? That means it takes every other part that your null did not take, right? And this is what? It is also what? The hypothesis that we would like to accept. Remember, your null is what? The hypothesis that you will want to reject. Also note that what? Your null must always have an equals to sign. Your null must always have an equals to sign, right? And your alternate does not have an equals to sign. So your null can take these values. Your H0 can be what? Can take an equals to value. So we can say H0, for example, let's say I'm trying to do a null for a mean. I can say my mean equals to, let's say, 0. Or I can say my mean greater than or equals to 0, or my mean less than or equals to what? 0. So anytime you are writing your null, there must always be that equals to in it. And for this, your alternate will be what? Your mean for the first one is not equals to what? 0. For the second one, because we said that what? Your alternate is what? The complement of your null. We say that what? The second one would be what? Your mean is what? Less than 0. And for the third one, it's what? Your mean is what? Greater than what? 0. You see, it is a complement of it. Because at the end of the day, your whole data must be what? Exhaustive, right? You must cover all of your data. And you can see that here. Right? You can see it here. You can have a null where it's an equals to null, and that is saying what? If you have an equals to null, then you have what? A two-tailed test, because your alternates can take two other sides. So for example, if I say my mean is equals to 5, that means my alternates can either be what? Greater than 5 or what? Less than 5. So we say that what? This is what? Two-tailed, because my alternates can take two sides, and that's what? Two-tailed. But if my mean is less than or equals to 5, then my alternates can only take one side, which is what? Greater than 5. And we say that what? This is what? One-tailed. If my mean is greater than, my null is what? Greater than or equals to 5, then my alternates can only take one side, which is what? Less than 5. And we say that what? That is what? One-tailed. So you should be able to differentiate between what? One-tailed and what? Two-tailed test. Right? Next thing you need to know is what? What charts do you use in doing your hypothesis, carrying out your hypothesis test? When you're dealing with mean or mean difference, right? You either use your what? Your T or your what? Your Z test. Those are the charts you use when you're dealing with mean or mean differences or differences in mean. Anytime you're dealing with mean, you use your T or your Z. But when you're dealing with variance, if you want to calculate the variance, evaluate the variance of a particular distribution, then you use your what? Your chi-square. Then when you want to compare two variances of two different distributions, to compare variances of two different distributions, then you use your what? F distribution, right? Those are the important things you need to know. First, we've learned how to state our null hypothesis and alternate hypothesis. We've known how to determine if it's two-tailed or one-tailed. Then next thing is what? Knowing the appropriate charts to use. When you're dealing with mean, you use either use your Z or your T. When you're trying to evaluate variance, value of a variance, you use your what? Chi-square. And when you're trying to compare between two distributions, their variances, you use what? F distribution. Please, let's note that. Then you should know what? Some descriptions, your level of significance is also what you call what? Your type 1 error, right? Your level of significance is your type 1 error. And your type 1 error is what? The probability of what? Incorrectly rejecting a true null. So you have a true null, but you reject it, right? So that's what? Type 1 error. Then your type 2 error is what? Probability of what? Not rejecting a false null. So you have a false null. For example, you've carried out an analysis and you said that somebody is going to default. However, you still went ahead to give loan to the person after you've evaluated that the person is going to default. That is what? A false null. You're supposed to reject it, but then you still went ahead to avail loan to the person, right? So that's what? Type 2 error. Then the power of a test is what? The probability of correctly rejecting your null. So power of a test is how you evaluate how the accuracy of your what? Of your model, right? And is what? 1 minus what? Your type 2 error. So if you are comparing between more than one model, you will choose the one with what? The higher what? Power, right? That is one you're going to choose. The ones that has the higher power or the ones that has the what? The lower type 2 error, that's what you're going to use. Then next is what? You will evaluate your test statistic. So in doing your hypothesis, to know if to accept the hypothesis or to reject the hypothesis, you will have to test it, right? And in testing it, you have to calculate your what? Your test statistic. Hi, Gloria. Hi, Gloria. Hello, Gloria. So, Gloria, can you hear me? Okay, all right. Brian can hear me. Okay, all right. Thank you. I just want to be sure. Thanks. Okay, so you need to calculate your test statistic. And in calculating your test statistic, you follow the general format, which is what? Your sample statistic minus what? Your hypothesized value, right? Your sample statistic minus your hypothesized value, divided by what? Standard error of what? The sample statistic. It is this test statistic that you calculate. You will now compare it with what? Your critical values that you will have read from your charts, or what you call what? Your theoretical values. Then that's when you will now decide if to reject or accept a null hypothesis, right? So an example would be, if I read my critical value, right? Let's say I read my critical value and I got 1.65 as my critical value for a two-tailed test. So I will have plus 1.65 minus 1.65, right? This is, let's say this is my critical values. This here will be what? The middle here will be what? My acceptance region. Then outside of this will be what? My rejection period, my rejection region, right? So if I now calculate my test statistic, let's say I calculate my test statistic and I got 1.7. If I bring 1.7 into this chart here, you will see that 1.7 is outside of it, right? So that means it falls outside of my acceptance region. That means I will have to reject the null hypothesis and go in favor of what? My alternate hypothesis, right? Yeah, so that's what we're saying. Then what? P-value. Your p-value is the smallest level of significance at which the null will be rejected, right? So what we mean by that is that what? If I have a p-value of 5%, that means this is the smallest value in which my null will be rejected. So if I carry out a test at 6%, then I must reject it. If I carry out a test at 10%, I must reject it, right? Because anything above my p-value must be rejected. But if I carry out the test at 3%, then I cannot reject. If I carry out the test at 2%, I cannot reject. So please note, your p-value is the lowest level in which you reject a null, right? The most important, I say, you should know your rejection points. So let's look at the next. Let's try and run through the next day and see if we can solve some questions. Your linear regression. So first, you should know your general linear regression. You should know your dependent variable, which is what? Your explained variable. And you should know what? Your independent variable, which is what? Also your what? Your explanatory variable. So the general format for your linear regression is what? Y equals to B0 plus B1 X1 plus. So this X1 here, this is your independent variable, and Y is what? Your dependent variable. We say that what? We are regressing Y on X, right? Then you should be able to determine the B here and the B naught and B1 are not observable. We have to calculate them. So the calculated version of your B naught, which is what? B naught cap and B1 cap has to be calculated. To calculate your B1 cap, it is what? The covariance of your X and Y divided by what? The variance of your X. And that gives you B1. And you will see the similarity between this and correlation, right? Your correlation is what? Covariance of X and Y. Covariance of X and Y divided by what? Standard deviation of X, standard deviation of Y. So you can see the similarity between your B1 and correlation, even though they are not the same thing. Your covariance only shows you direction, but it does not tell you the exact relationship between them. But your B1, on the other hand, shows you their rates of relationship, right? So, and you can see, so you can also check it in your other topics like portfolio management and all of that, right? Where you're comparing your B1 to what? Your correlation. And to calculate your B naught, you use your what? Expected values of your Y and your X to estimate your B naught. After you've calculated your B1 from here, you will now slot it in this formula. Then you use your expected values for X and Y. Right? In regression, the baseline we use is the one that what? Minimizes your what? Sum of what? Squared errors. Right? And that's the one we use. Next is what? You must know your general assumptions in linear regression. One is what? That a linear relationship exists, right? Two, there is homoscedasticity, which is what? There is constant variance. Then three, your residual terms are what? Independent. That means you cannot use your variables to determine what your residual terms are. There should be no relationship between them, right? Then your residual terms should also have what? A normal distribution, right? So let's look at a chart and see. Okay, so what we are doing in regression is basically what? Analyzing our variance. Variance means that the difference between our actual values and what? Our predicted values. We are trying to find the difference between the two, right? Right? So that's what we're trying to analyze. What is causing the differences? I want to see if the independent variable explains to us the differences we are seeing, right? So first, let's look at the total sum of squares, which is the total variable that exists, right? Which is y minus y bar squared, right? Then your regression square, which is what? The error that you can explain, which is what? Your regression sum of squares. That means of this total sum of squares that you've noticed, of these total errors that you've noticed, this is the one you can explain here, right? Then your sum of squared errors is the unexplained part of what? Your variation, right? Sorry, let's look at what it looks like in the chart. So let's look at it in the chart. What we are saying is this: your total error, SST, the one you can explain out of it is RSS, right? And the one you cannot explain is what? SSE. Your RSS or SSR, however you want to call it, plus your SSE equals to what? Your SST. And you also need what? Degree of freedom. The degree of freedom for your RSS is what? K, which is what? Your number of what? Independent variables, right? Then the degree of freedom for your error is what? N minus K minus 1. And since what we are dealing with is ordinary regression, which means that what we are only dealing with what? One independent variable. So this can summarize into what? N minus 1 minus 1, which is what? N minus 2. And your total will be what? So this will be what? 1. So 1 plus N minus 1, N minus 2 will be what? N minus 1. So you can see the way we got what? Our total degree of freedom. Then to calculate your mean of squares, it is what? your mean of squared error or your mean of squared regression is what? Your RSS divided by what? The degree of freedom. And since we are dealing with ordinary regression, that means that what? It will still be the same thing because your K is what? 1. And your mean of squared error is what? Your SSE divided by what? N minus K minus 1, which is also what? Your SSE divided by what? N minus 2. And your F statistic, right, is what? Your MSR divided by what? Your MSE. Also, your SEE, which is what? Your standard error of estimate is what? The square root of what? Your MSE. So those are the things you need to note, right? Sorry, please. Then to calculate your test statistic, like we've always been doing, is always your what? Your T. Your T is what? Your B minus what? Your hypothesized value divided by what? Standard error. It still follows the same format as we did in what? In your hypothesis testing, right? Also, your P values is still the same thing, which is what? The smallest level of what? Significance, where you reject your null. Our null under linear regression is what? We are trying to test if this equation is significant, right? That if the variation in the independent variable can be explained by what? The independent variable. So we are trying to test if this B1 we have is what? Equals to what? 0. So our null hypothesis will be what? That B1 equals to what? Is 0. And like I said, what do we want to do to the null hypothesis? We would like to what? Reject the null hypothesis. Because if you are able to reject the null hypothesis, then we'll be able to say that what? That our independent variable can explain what? To a large extent, the variations in what? Our dependent variable. You can also use, in linear regression, you can also be asked to what? Predict values. When you are predicting value, all you just need to do is what? Use the functional form of your equation and slot the values in. All you need to be careful for is what? You have to look at the functional form, either if it's a log-lin model, a lin-log model, or a log-log model. So a log-lin model will be something that looks like this. Lin y equals to what? B naught plus B1x. This is a what? A log-lin model, because this is log and this is what? Linear, right? A lin-log model will be what? Something like this: y equals to B naught plus lin, B1 lin x, right? Note, your formulas must be linear in B naught and B1, right? They must be linear in B naught and B1. So I cannot have lin B1. No, it is B1. So it is B1 lin x. You cannot have lin B1x, right? So please note that. Okay. Hi, Gloria. Hear me or Gloria? Anyone?
Hi, Ibrahim.
Yeah, sorry. I know we run out of time. I know they have break next. Can I take 15 minutes to just solve some few questions for them?
Okay. I think that's okay, but please 15 minutes so
15
that
minutes.
can take a bit of break.
Yes.
Yeah.
Thank you very much.
Okay.
All right, so let's look at some common questions. First, let me solve these questions on linear regression, because linear regression is very new reading in your level 1, right? So let's look at this question. It says SP Jones is examining the relation between the net profit margin of companies in percent and their fixed assets turnover. He collected a sample of 31 companies for the most recent fiscal year and fit several different functional forms, settling on the following model. So this is the model he settled with. Lean NPM I equals to B0 plus B1 FATO I. He said the results of the estimations are provided in the exhibit below. So this is the result that they provided us with, right? So this is the results. They've given us the source of variation, the regression, the residual, and the total. And they've given us the sum of squares, right? So this is a format in which, and they've given us the P, and they've given us what? The regression output itself. Question now is this: they've asked you questions, but then I've deliberately omitted value here. So who can tell us what this value is supposed to be? Yes, that's the ANOVA output. Yeah. So Chidima says 32, right? Like we said, your degree of freedom is what? For total is what? The degree of freedom for the regression plus the degree of freedom for the residual. So for you to get the degree of freedom for the residual, you just need to subtract that of regression from it. That will be what? 33 minus 1. And that is what? And that is 32. Right? Then if I ask that, what is, so I would add this like that, right? So now let's look at the questions. He said the coefficient of determination is closest to what? What is coefficient of determination? Which is coefficient of determination is what? R squared, right? Which is also what? The ratio of what? Your RSS to your what? SST. So what is RSS here? Your RSS is what? Sum of squared regression, which is what? 102.9152 divided by what? Your total, which is what? 105.1303, right? And that will give you about 0.9789. And that is your R squared. The other thing they can ask you is what? What is the correlation between them? For you to calculate the correlation, all you just need to find what is the square root of what? Your R squared. So your correlation is what? The square root of what? Your R squared, right? And that gives you your correlation. Next question, the standard error of the estimate is closest to what? Question, it will be what? What is standard error of estimate? The same thing as what? Square root of what? Mean squared error. And what is your mean squared error here? This is your mean squared for the residual, which is what? Square root of what? 0.0692, right? And that will give you about what? Is 0.2631, right? Next question. At a 0.01 level of significance, Jones should conclude that what? A, the mean net profit margin is 0.58. So question is this, what is the significance of this is 0.01 first? Here it says that what? It says the p-value is what? It's 0.0000. That means this is the level at which the null will be rejected. The lowest level the null will be rejected. So that means at 0.01, which is greater than 0.0000. That means that what? We will still reject the null, right? And if we reject the null, we will say that what? B1 is not what? Equals to 0, right? So once we know that, then we know that what? This cannot be correct because this B1, B1 for your coefficients has a value. So it cannot be 0. If it was 0, then this would have been correct, but it is not 0. So we cannot say that. So A is not correct. The variation of the fixed asset turnover explains the variation of the natural log. Yes, this statement is correct because we have failed to reject the null. That means we are saying that what? The independent variable can explain some variation in what? The dependent variable. And so the answer here is what? B. Question 3. The predicted net profit margin for a company with a fixed asset turnover of 2 times is closest to what? So this is where the tricky questions come. These are the forms where the tricky questions come. You are asked to predict. And look at your functional form. It says lean NPM equals to what? B naught plus B1 factor, let's just say F, right? Now we know what our B naught is. What's our B naught? From the coefficient, you can tell what our B naught is, right? Which is what? Is 0.5987 plus B1. What is B1? They said what? Our F is 2, right? So it will be what? Is 0.2951, which is our B1, times what? 2 equals to what? Lean NPM. So if you calculate this, you will get something that looks like this: 1.1889%. But note, this is not your answer, because your functional form is what? Lean. And this is where people make mistakes, right? So you still have to find the what? The exponential. So you do NPM itself is what? Exponential 1.1889. And that will give you what? 3.2835%, right? Please, those are the things you need to what? Be careful. For. Next, let's look at some other questions. So let me see. So let's just look for some random small questions, right? This question here, it says, in a discrete uniform distribution with 20 potential outcomes of integers 1 to 20, the probability of x, that x is greater than or equal to 3, but less than 6. So he said that what? X is greater than or equals to 3. That means that what? 3 is less than or equals to x, right? Then they say x is what? Less than 6. That means 6 is greater than what? X. So that means x can take on what values? 3, 4, and 5, right? Those are the values x can take. And we have how many values in total? 20. So what is the probability? That would be what? 3 over 20, and that would be what? 0.15, right? Straight up like that. So let's look at this question. This question, it said for a sample size of 17 with a mean of 116.25 and a variance of 245, the width of a 90% confidence interval using the appropriate distribution is closest to what? So question is this: how do you determine the width? We said that what? To build an interval, you need what? Point estimate plus or minus your reliability factor times what? Your standard error. So that will be what? What you have is what? So you have point estimate minus reliability factor times standard error, which will be what? Your lower limit. Then the upper limit will be what? Point estimate plus reliability factor times standard error. And this will be what? Your upper value. So the width will simply be what? The difference between the what? The upper minus the lower value. And if I say upper minus lower here, all I will end up having is what? 2 times reliability factor times standard error. That is what I'm going to have. So now let's get our calculations. What is our standard error? We are given the variance as what? 245.55, right? And our sample size is what? 17. So our standard error is just simply what? The square root of this, right? Which is 245.55 divided by what? 17. And the square root of that is 3.80. Then our reliability factor, we are dealing with what? 90% confidence interval. So we will go and read 90%. Since our sample size is small, right? We'll go and read samples. It's best we use what? T, right? Student T. So we'll go and read 90% under T. And that will be what? I'm sure we all know how to read our T table. So our T for 17 under 90 that's what? 1.74. Right? That is 1.74. So we have 2 times 1.74 times 3.8. And that's what? So, sorry, please, hold on. We said, so yeah, we'll be reading, instead of reading for 17, we'll be reading for 16 because it's what? N minus 1, right? That is what? 1.746, right? So 1.746 times 3.8 times 2. And that's what? 13.27. So you can see how it's calculated, right? So those are things you need to watch out for. Then, yeah, it says that what? Suppose we take a random sample of 30 companies in an industry with 200 companies. We calculate the sample mean of the ratio of cash flows to total debt for the prior year. We find that this ratio is 23%. Subsequently, we learn that the population cash flow to total debt ratio is 26%. What is the explanation for the discrepancy between the sample mean 23 and what? The population mean of 26? That's just simply what? Your sampling error, which is what? The difference between what? Your sample statistic and what? Your population parameter, right? We are out of time, so let me see if there's any charts. So how did we get to, which is why I tried to solve the formula for you, right? And showed you that you have an upper and lower limits, right? If you add these two things together, if I say this plus, if I say this minus this, right? If I subtract them, upper minus lower, this will cancel this. Plus minus minus, this will be 2, because this will be RFSC in 2 places. Right? We have the point estimate plus here, then minus here. So you take this part and you take the positive part too, right? That's how you get your 2. Let me see, is there another question? Base formula. Let me see if I have base formula. I can't seem to find a base formula, but I can show a counting problem. Yeah, let's solve this counting problem. A firm will select 2 of 4 vice presidents to be added to the investment committee. So we say you have what? 4 vice presidents, and you want to select 2 out of them. So you are saying 4 select 2, right? And that what? 4 combination 2, right? So if you press that on your calculator, 4 combination 2, what do you have? The 4 second function combination 2, right? And that is 6, right? 4 combination 2. Right. Let me see if I can see a very fast question to solve, but I think we're out of time. All right, so those guys, just like I said, your LOS has lots of calculations in them, but then try and know the reasons behind the calculations, right? Which is the most important part, the interpretations of your calculations, your null hypothesis. If you see hypothesis testing, it has lots of formulas, but do not concentrate on the formulas. Concentrate on what? The interpretations. What is your null, your p-values, what charts do you use, what test statistics do you use, right? How do you determine your rejection period, region? Those are the things you should focus on and less on the formulas themselves, right? Because most of the LOS are all about interpret, explain, right? That's what your LOS is mostly about. Hi, Gloria. Yeah, done.
Hi, Ibrahim.
Yeah.
Okay. Thank you very much. Thank you very much for the invitation.
So in case anybody wants to reach out.
Yes, that's fine. You can share in the chat. That's fine. And also, would you like to share your slides with the candidates?
Yeah, sure. I can share with you, right? So.
Okay. Yes, you share with me. I'll send it to them as a PDF by email.
Yes. Yeah. So.
All right. So we'll take a short break and we convene at 2:25 p.m. for fixed income. That's the third class for the day. So 2:25 p.m. But I'm not going to turn off the Zoom call. We'll just pause for a while and reconvene. So please, guys, feel free to stay back on the call. You don't need to log off. Thank you.